Thank you, sir. A very good morning, everyone. On third day of National Conference on International Taxation, I welcome all of you. Dear friends, today two important topics on international taxation. First, withholding taxes on in payment to non-residents. That is section 195, 196, including form 15CA CB. And the second topic is tax treaties dispute resolution mechanism will be covered. And for these topics, we have two eminent speakers, CA Karthik Mehta from Mumbai and CA K. Sudarshan from Chennai. I welcome both of you, sir, on this forum. Welcome, sir. Now I request our young and dynamic chairman, CA Saket Bagdia, sir, please give his welcome remark. Over to you, Saket, sir.
Thank you so much, Sanjay, sir. Sanjay Agrawal, Secretary of the branch. The speakers for today, CA Karthik Mehta ji from Mumbai, CA Sudarshan Rangan ji from Chennai, and all the respected delegates who are present in the early morning to learn more about this international taxation. Friends, it is always said that when we need to venture into this international taxation, time is not the bound for us. You know, in some countries it's early in the morning and in other countries it's late in the night. So therefore, I feel that we starting early at 8 is just the right time for you to get yourselves acclaimed to that international practice area which you are going to venture into. I'm really fortunate to have the two wonderful speakers for very two important topics today. Karthik Mehta ji to speak on 195 section 15 CA-CB. You know, friends, this is the most talked about topic because as a professional, we are involved more of day in day out after about many issues which may be related to this thing, whether a form 15 CA has to be issued or not, whether form 15 CA has to be issued by the SSC-CB to be certified by the chartered accountant or not, and then also about section 195, whether the TDS has to be deducted or not. There are so many things which otherwise then as an international tax practitioner also we need to take care while we are doing the audits. So that's going to be a really practical and important thing for all the participants today. So I thank Karthik ji for his precious time for preparing it for the benefit of the participants. Sir, I can tell you that all the participants are great learners. I've seen this since last 2 days because they are very inquisitive and they learn and they wish to learn and ask so many questions on that. So, sir, you have got the best of the delegates to attend this session, and I feel that this is going to be a really good session. Sudarshan, sir, the next topic, that is dispute resolution about tax treaty, I have not put in the entire topic because the topic is really wide, and that is a thing which is really going to be of help while you are doing the professional practice. Because understanding a topic and then interpreting it and then going to the resolution of that is really going to be a big challenge for you. Friends, before Sanjay sir really introduces Sudarshan sir, I was really impressed while I was reading his biodata when I said that he's a certified cricket coach as well. So you friends, a man who is a multifaceted personality is going to teach you on many other things which are of going to be of professional importance to all of us. I welcome all the delegates to this third day of International Tax Convention. The recordings of both the two sessions would be available to you. We would be making them available today itself. And I request the speakers, I'm going to add you to a WhatsApp group that has been created specifically for the participants, because this is now going to be international, this is going to be a national group of international tax practitioners made through Nagpur for the benefit of all the people. So I would add both of you to that group so that you can share your presentations as well on that, and maybe that the people who may be having their queries, they can have a discussion on that forum as well. So thank you so much. Thank you, and thank you all, as I welcome all of you to this third day of international taxation. Tomorrow we are going to have another very interesting session, and there's going to be a panel discussion which cannot be missed because that is going to be related to all the professional opportunities that can be created in this international taxation. So thank you, and thank you all. Over to you, Sanjay now.
Thank you, Chairman sir. Dear friends, I take the opportunity to introduce our first speaker on the topic withholding taxes on payment to non-residents, CA Karthik Mehta sir from Mumbai. FCA Karthik Mehta has vast experience in domestic tax, transfer pricing, foreign exchange regulation, as well as in international taxation. CA Karthik Mehta also has extensive experience in representation and litigation, and his enterprising trait has led him to him working besides some of the best Indian counsels. CA Karthik Mehta plays an active role in various committees of the professional associations and has been part of the team that have made several representations to the statutory authorities and regulators. He has also contributed several articles on various complex direct tax laws issues in known tax journals. Please welcome CA Karthik Mehta, sir. Welcome, sir.
Thank you, sir.
We have another speaker on the second topic. Tax treaty dispute resolution mechanism, CA Sudarshan, sir. CA Sudarshan, sir, is also a law graduate. Sir has also done his master's on international taxation law from the Vienna University of Economic and Business. Sir has his major area of focus are into business restructuring, transfer pricing, taxation and regulatory laws, sports and entertainment law, insolvency and data privacy law. Sir has been involved in commercial arbitration, including sports and investment arbitration and commercial mediation for parties in India and outside India. Sir has advised on various complex cross-border transactions, including merger and acquisition, foreign inbound and outbound, etc. Sir has also undertaken policy and research-based projects through a global tax think tank called Global Tax Laboratory. Sir has many international publications to his credit, and Sir is also a guest lecturer in various professional institutions across India and Europe. Other than academic front, Sir is a certified cricket Australia coach, and Sir also managed two NGOs, Saket and the Melcote Trust. Melcote Trust provides education for underprivileged and downtrodden kids in rural Karnataka, and Saket empowers, educate and employs transgender treaty, endeavoring to create an inclusive community. So please welcome such dynamic personality K. Sudarshan with a big round of applause. Welcome, sir. And now, without taking much time, I request CA Karthik Mehta, sir, please take the proceeding and deliberate his. Over to you, Karthik, sir.
Thank you. Thank you, CA Saket Bagadia, Chairman of the Nagpur branch, and CA Sanjay Agrawal, the Secretary of the Nagpur branch, for inviting me and giving me this opportunity to share my thoughts on this important topic. And if you guys give me a minute, I'll quickly share my screen. I hope my screens are, perfect. So friends, today's topic is withholding tax on payments to non-resident, and we'll cover section 195 and the related aspects. And this section is very, very important in today's tax arena. With this advent of digitalization, global business is coming into picture. Today, a resident company or a resident taxpayer frequently deals with non-resident businesses, non-resident entities, and cross-border payments, which were very rare until a few years ago, have today now become a thing which is very common. Especially in the last 1.5 years, due to the pandemic that we are facing, a lot of services are being availed by people, most of them online and many of them from non-residents. And friends, whilst we may not realize, but on a day-to-day basis, we are availing services from non-residents, be it likes of Google, Amazon, LinkedIn, Facebook. So at some of the other place, we are interacting with these non-resident companies, and these are just some big names that that everyone would know. But even if you look in the commercial world, you would be using softwares like QuickBooks for accounting, Zoho for for your customer records and everything. It's a CRM tool, and so many other softwares that we keep on using, for which the Indian company needs to make continuous payments to the non-resident, and that's where this section 195 and the withholding element comes into the picture. So friends, just to maybe go a couple of steps back and look at what is the basics of a withholding. The fundamental principle is that tax should be withheld at the earliest possible in time, right? The government needs to have recurring cash flow, inflow of income for its own operations, for its own administration expenses. Withholding ensures that taxes are collected in time at the earliest point in time, and it also helps the government to keep the tax evasion in check. Because let's say, for example, friends, if in the case of a withholding, right, withholding happens when the recipient is a resident as well as a non-resident. In the case of a resident recipient, there are sections given under the law, and they are fairly simple, they are fairly straightforward, subject to certain exceptions. And even if the withholding happens or doesn't happen, the government knows who the taxpayer is, can get hold of him, can access the taxpayer. However, when it comes to the non-resident recipients, it is very important for any government to collect the taxes at the earliest point in time. That is when the non-resident is getting paid. Simply because if, let's say, there is a shortfall in tax, the government finds it very difficult to then approach that non-resident recipient, to get hold of the non-resident recipient and try and collect the tax from such non-residents. One, of course, would be the administrative cost that is involved in locating the taxpayer, the non-resident in another jurisdiction. But the most important point is the jurisdiction over the non-resident, right? If there is a taxpayer situated in the US, the Indian tax authorities per se do not have any direct jurisdiction over the taxpayer located in any jurisdiction outside of India. And hence it becomes absolutely important that there are provisions under the law which ensure that adequate and right amount of taxes are allowed to be withheld at source, so that there is no loss to the exchequer in this entire remittance process to the non-resident. Now, whenever we talk about withholding, it may because we are so keen to understand withholding on the on the domestic front, we look at typical section 194J, 194I, and 194C, and we say that, okay, what's the big deal? If this is the amount, itna amount hai, itna tax kaat ke bhar do, and give the balance to the resident recipient, and that's it. However, when it comes to the non-resident payments, it is very important to understand the entire scheme of the act, because only and only once you are able to ascertain that whether this payment that you are making is chargeable to tax in India in the hands of the non-resident, only if that income is subjected to tax in India, that's when the need to withhold arises. And that is why before going to 195, it is absolutely imperative to understand the scheme of the income tax in terms of taxing the non-residents' income in India. So again, some very fundamentals. Section 4 of the Income Tax Act talks about the chargeability of income tax. It provides for what all income is chargeable to tax in India and when it shall be paid. So either it would be paid as a deduction or it would be paid in advance. Friends, so as we all know, right, income tax scheme provides for tax deduction at source, tax collection at source. You discharge your tax liability by way of an advance tax. And finally, after all these things, if there is a shortfall, you pay it by way of a self-assessment tax. So the idea is to ensure the tax on a concurrent basis, as and when the transactions are, as and when the year is going by. So section 4 provides that whatever tax is due on the income which is chargeable, you would either pay it by way of a deduction or you would pay it in advance. Now, moving on, section 5 provides for the scope of the income which is chargeable to tax in India. Now your section 5.1 talks about the scope of a resident's income which is chargeable to tax in India. Today we are not concerned with that. Today we are concerned with the second limb, which is 5 subsection 2, which talks about what all income of a non-resident is chargeable to tax in India. So for a non-resident, income which is received or deemed to be received in India is chargeable to tax in India. Income which accrues or arises or deems to accrue or arise in India is chargeable to tax in India. Now, insofar as income which is received in India or accrues or arises in India, it's fairly straightforward, right? If you look at the facts of the case, if you look at the transaction, you will be fairly be able to conclude that yes, this income is arising in India, hence the income will be chargeable to tax in India. However, the complication, the challenges, the complexities arises when you go on to section 9. Section 9 is a section which is extremely important to understand when it comes to a non-resident's taxation of income which is deemed to accrue or arise in India. And because we are concerned with the withholding, therefore it becomes important to understand first whether this income is chargeable to tax in India or not. So section 9, friends, has evolved over time. It's extremely I wouldn't say complicated, but extremely deep section to understand. Lot of nuances, explanations are being added every year, be it business or profession, be it royalty. The government is trying to widen the scope of non-resident taxation, including more and more elements in what can be construed to be as an income deemed to accrue or arise in India for the non-residents. And whilst this is a topic in itself, I believe it is important for us to at least go through this section 9, because most of the complications that we face today in terms of the non-residents income arising in India or not emanate from section 9 under the Indian domestic tax law, read with the corresponding articles in the double tax avoidance agreement. So section 911, friends, deals with the business and profession income of a non-resident in India. It also talks about certain capital gains or certain consideration received on account of a transfer of a capital asset, interest share, which is based in India or deriving its value from India, and any other source of income that the non-resident may earn. So it's again very important to understand that what kind of a non-resident's business income is chargeable to tax in India. So let's take an example. One of your clients is importing goods from a foreign exporter who is exporting goods into India. Now, this foreign exporter does not have any presence, any connection in India. Your Indian customer, your Indian client, the Indian company has just looked at its global website or some advertisement on a foreign web page, and has tried to order the, place this order for the first time. Now, under the provisions of section 9, it is important that a non-resident is a business connection in India for any income to be liable to be taxed in India, or there should be certain agents or certain people who are trying to secure a contract in India. Now, in absence of any of this activities on the part of the non-resident, such income may not be chargeable to tax in India if it is a pure import, right? So therefore, it is very important to understand how the technical provisions under section 9 work, right from 9.1 to 9.8. Let's modify the facts a little bit. Let's say your Indian client, the Indian company, wanted to place a order for a very large machinery from a non-resident equipment manufacturer. So let's say their team comes down to India, they do the site visit, they take all the measurements, they enter into negotiations with the Indian client of yours sitting in India. The agreement is negotiated and finally the price is arrived at and the agreement is signed in India. Now, and that's when, and then the team goes back and now you are supposed to make a payment for this purchase of equipment. Now, under this facts and circumstances, the scenario completely changes. Now the non-resident has a business connection in India. The non-resident has performed certain activities in India, which has led to an income arising event for the non-resident, right? So that is why whenever we are evaluating our client's transaction, where if they've made a payment to a non-resident on account of any business or profession activities, it is very important to understand what is the actual transaction, how have the events and the facts transpired, what all sort of a establishment or a presence does the non-resident have in India? Is it represented in India through its agent? Is that agent dependent completely on that non-resident for business, or is it an agent performing business, for several of principles like this? Does the non-resident have any employee in India? Is the non-resident's employees from foreign traveling to India? All these things become extremely important, and then only you can go to section 9(1) to understand whether it gets covered within the ambit or not. And similarly, okay, so once you have evaluated under the domestic tax law, it also becomes important to look at the corresponding articles under the DTAA if India has entered into a double tax avoidance agreement with that country. So friends, we will go ahead and look at the different provisions, but just to maybe share a couple of points over here. Whenever India has entered into a double tax avoidance agreement with any country, and there is an article under the treaty which typically governs a particular stream of income, and whenever you are evaluating such kind of a payment to a non-resident, you need to look at the domestic tax law provisions as well as evaluate the same provisions under the treaty, and then whichever provision is beneficial to the non-resident, to the taxpayer, is ultimately what you can choose from. Of course, there are certain nuances and conditions attached to availing a treaty benefit, and we'll get to that as we move ahead. But once you have evaluated the implications under the domestic tax law, you also need to evaluate the implications under the treaty. For example, if a transaction is what you conclude that is not chargeable to tax in India under the domestic tax law itself, and you are absolutely certain about it, then referring to the treaty and evaluating it under the treaty is a rather academic exercise, because once the act itself says it is not chargeable to tax, there's no need for us to go to the treaty. However, if you were to conclude under the domestic tax law that certain income of a non-resident is chargeable to tax, and hence you will be liable to withhold taxes, that's when you will then take the recourse to the double tax avoidance agreement and analyze the treaty provisions to see if the same income, does it have some concession under the treaty? Can I get outside the ambit of the taxation under the treaty? And that's how then the non-resident's income will not be liable to be taxed in India. So one needs to do a careful analysis of the domestic law as well as the treaty. Similarly, after 9(1) also includes the capital gains which if a non-resident earns from any interest in India or of an entity controlled in India, and especially when the value is derived from India, even if the transfer happens at the non-resident level. So friends, we all know the important decision of the Vodafone which had come many years back, right, where the Honorable Supreme Court opined that because the law as it then existed did not provide for taxing the transfer of a non-resident company shares by a non-resident to another non-resident, but that non-resident company was deriving its value substantially from India, right? But because as of that day, there was no law that existed, and that's why the Supreme Court had held that the non-resident acquirer was not liable to withhold tax on the gains which the non-resident seller had earned. Thereafter, of course, we know that there has been a retrospective amendment which has been brought into Section 9 and which now provides that whenever a non-resident is acquiring the shares of, let's say, another non-resident company from a non-resident seller, but if that non-resident company is deriving its value from India, then such kind of gains that the non-resident seller is earning is liable to be taxed in India. This again is subject to, of course, the double tax avoidance agreement articles and provisions. So again, after going through the domestic tax law, one needs to evaluate what is the position under the double tax avoidance agreement. Moving on, section 912 and 913 refers to salary. Now, salary payments to a non-resident, right? Again, this has become fairly common because of the cross-border transactions that keep on happening. There may be a possibility that an Indian company's employee has been deputed to a foreign jurisdiction like a US, UK, Canada, Dubai. Likewise, there is a possibility that a foreign company's employee is deputed for a short stay over here or for some number of months over here, and that's when again even though the person has stayed for a very short time in India, the status continues to be that of the non-resident. However, the ambit of section 195 doesn't cover tax withholding obligations on salary. Any tax withholding, even for non-resident, continues to be covered under section 192. So like how your any resident's salary is taxable and tax withholding happens under 192, section 912 and 913 also the income which is generated under these two sections also gets governed by 192 itself. Now, moving on, section 914, dividend. This has become extremely important now that the dividend income is no longer exempt in the hands of the recipient, but is chargeable to tax. No longer exempt in the hands of the recipient, but now is chargeable to tax in the hands of the shareholder recipient, and that is why withholding on account of dividend payments has become extremely critical for us to understand. So what happens, friends, is that let's say if there is an Indian company where the shares are held by a non-resident. So when you are, let's say, and there is another shareholder of this Indian company who is a resident. So when you are paying, the dividend to the Indian shareholder, you will simply withhold at 10% because that's what the domestic tax law provides for a resident, and you will move ahead. However, when it comes to the non-resident, you will have to look at several of aspects, and we'll discuss them as we go ahead. But under the domestic tax law, you will first decide whether it is dividend or not, as we understand under the meaning of section 2, subsection 22 of the Income Tax Act. If that is the case, then you go to the relevant section, which is section 115 capital A. That provides that the dividend income will be taxable in the hands of a non-resident at 20% plus surcharge and cess, and the deduction thereof needs to happen under 195. So under the domestic tax law, we understand this is the situation. However, when you come to the DTAA, and it becomes imperative to analyze DTAA for the dividend transaction, simply because you need to understand that who is the beneficial owner of the recipient of this dividend, whether this payment under the treaty constitutes dividend or not, what is the withholding tax rate which is provided under the DTAA for this payment which is happening from an Indian company to the non-resident shareholder recipient, whether that treaty has a MFN clause, most favored nation clause or not. We'll discuss a couple of these aspects as we go ahead, but it becomes extremely important now when your Indian company, your Indian clients have a foreign shareholder and they are remitting or declaring dividend to the shareholders, and then finally the money is remitted from India to the foreign shareholder. Another very important aspect where, again, as chartered accountants, when we are advising our clients on any transaction that our Indian clients are taking with a non-resident company, because of the digitalization and everything moving online, many softwares, many IPs, we continuously keep on accessing them through the digital means, and any payment that we have to make could arguably be characterized as a royalty or a fees for technical services. So we are on the Zoom platform right now, right, where this session is being conducted, right, and there is a subscription charges that needs to be paid for Zoom. We all use Gmail or Microsoft or similar email service providers on a day-to-day basis. We keep on making a payment to them. What would be the characterization? Would they be categorized as royalty? Would they be not? So all our day-to-day exposure to these kind of transactions have increased manifold. Today, a lot of online courses are happening, and why I'm raising these specific instances or specific items is because, friends, you would experience, or you would have witnessed your clients coming to you and asking, should I withhold tax? Tax katna zaruri hai kya? Especially on these type of transactions. A couple of their employees have done, have taken a couple of courses on Coursera or any other website similar to that, and then they are getting a certification course, whether it constitutes royalty, whether it constitutes FTS under the act, under the treaty, and then finally whether you are supposed to withhold tax or not, subject to certain other things. It is very important for us as chartered accountants today to understand all these things, right? Because of two things. One, we are advising our client, who will rely on our advice and then proceed ahead accordingly. If for whatever reason the view is incorrect, the client gets exposed to disallowances, interest, penalty, and so on. So that's one part. Second part is, if let's say we as professionals also need to issue a form 15 CB for that particular transaction, right? We are certifying, right, that this transaction we've reviewed, we've analyzed, we'll be giving our supporting notes to that, and then ultimately, if let's say the department comes, when they review this transaction and they find certain basic deficiencies in our analysis, and basis which we had issued form 15 CB, it can also lead to repercussions, adverse repercussions for the chartered accountant as well. So friends, it is extremely important to understand the transaction first, look at all the supporting documents that you have. Please just don't take the invoice, take the agreement, and have your team members make form 15 CA and upload 15 CB, give it to the client, file form E2, and then the money goes out of the country. It is a very, very dangerous thing to do.
Sir, can we ask a question here?
Or
yeah, at the
end? I think we'll do it at the end. I think that will be better. If that's
actually, because you just took a very important, which is very practical, this thing, and
yes,
you have not answered the query which you have raised, whether it is a fee for technical services or not, when you are paying, right? So that's my concern. Thank you.
No. So, ma'am, whether it's something is royalty or something is FTS, of course, both are different sections. But if let's say a transaction is there, whether it is royalty or not, there are several things that one needs to analyze. First, one needs to go through section 916 itself. And if let's say, you go through the various explanations given under section 916, the definition of royalty under the domestic law is so wide that almost everything under the sun is covered under the definition of royalty, right? But that's when the non-resident can, take the shelter under the treaty. Under the treaty, most of the treaties still have a very limited and a narrow definition of the term royalty. And many of the things that our domestic law deems it to be a royalty under section 916 is generally outside the purview of, the definition of royalty under the treaty. So it's an extremely fact sensitive analysis that one needs to do. And even after analyzing this, need to understand that whether you are eligible to take treaty benefit or not. And I make this statement why? Because see, if it is your recurring client, if it is a transaction of a very high volume, even the non-resident will take efforts to provide all the documents that our law wants us to obtain from the non-resident, like a no PE declaration, form 10F, TRC, and so on. We'll cover that also in the later part. But let's say this is just a one-off transaction where you are making them a course payment of, let's say, just a simple $2,000. And that company is a huge company providing, courses like this to millions of students across, or millions of professionals across the globe. If we write them, if we keep on following up again and again for these kind of documents, it is very difficult to get all these documents from them in one go unless they are well versed with the Indian laws. Then their tax advisors would have advised them to have all these documents ready, and then they would provide it to us in one go, right? So if you if let's say any of your clients subscribes to LinkedIn, right? And initially, whenever we used to subscribe to LinkedIn, the payment used to be made to LinkedIn Singapore, right? If you become a premium member on LinkedIn. Now, the moment they shared their invoice with you, they had a docket ready. In that docket, they used to give you the no PE declaration of LinkedIn Singapore. They used to give you a Form 10F. They used to give you TRC and any other document that were required by you to avail the treaty benefit under the India-Singapore DTAA. Because if they didn't provide, the Indian company would categorize the payment that is being made to LinkedIn Singapore as royalty and withhold tax at source. However, if they provided these documents and then they are eligible to take treaty benefit under the restricted definition of the term royalty, in the DTAA, the Indian company would not be obligated to withhold tax. So those non-residents who are doing a large amount of business in India have been advised by their Indian consultants to have all of these documents ready. Generally you will observe that along with the invoice, they will also share all of these documents to the Indian company so that the Indian company can undertake the analysis at its own end, and everything is in order, give the relief under the DTAA. So very quickly again, when it comes to royalty, friends, under the domestic tax law, the rate is favorable. It is 10% plus surcharge and cess. When you read it with section 195, read with 237A, which is the rate or rates in force. Under the treaty, whilst the definition is restricted, but if you are covered under the definition of royalty under the treaty, the tax rate is 15%. So if any payment is taxable under both the act as well as the treaty, one would obviously go under the act itself, because the withholding rate is just at 10% plus surcharge and cess, which would be substantially lower than the treaty rate. However, if under the treaty you want to take a shelter and you want to say that no, this amount doesn't constitute as royalty under the treaty, that's when you will take recourse to the double tax avoidance agreement. Now, friends, this payment on account of royalty has created tremendous litigation. And because this is a recent decision of the Supreme Court, which has just been rendered a couple of months back, I thought that, I'll just spend 2 minutes on this and discuss the propositions which were adjudicated by the Supreme Court. Because again, this is something which we face on a day-to-day basis. We all take subscription to, to softwares. We all take licenses of softwares, and there have been hundreds of decisions across the country in favor and against. And finally, this controversy has been put to rest by the Honorable Supreme Court in the decision of engineering analysis. So purchase of software by resident end user from foreign supplier or manufacturer. So let's say your client is taking a subscription to QuickBooks, which is an accounting software, directly from QuickBooks US. So this doesn't constitute royalty under the Act. That is what the Supreme Court has laid down in this decision. It's a 200-page plus decision, friends. I would urge all of you to take time, read the decision. The references drawn in the decision by the Supreme Court to the Copyright Act, some international, references are amazing. Academically also, it will help tremendously each one of us if we are able to grasp the principles that the Supreme Court has discussed in this hearing. The another proposition that the Supreme Court discussed is purchase of software by a resident distributor reseller from the foreign supplier manufacturer. So what happens, friends, is that many a times there are Indian resellers and distributors. So take an instance, your Microsoft Office license. Now, whilst you may purchase one license, 2 licenses from the Microsoft website itself, Microsoft has also appointed Indian distributors resellers. So if your company has 200 people, 500 people, and you want to buy a bulk license, then you would much rather go to this distributor because he will give you a better pricing also per license for that. So again, on this front, there was litigation which was prevailing, and Supreme Court has put to rest even on that front. Purchase of software by the Indian distributor reseller end user from a non-resident distributor seller. So if let's say the Indian distributor in our current example doesn't buy the Microsoft licenses for reselling directly from Microsoft, but he buys from another non-resident reseller distributor. Or let's say me as an end user, buys from a non-resident distributor reseller, even then the Supreme Court has said this doesn't constitute royalty. There is no need to pay, no need to withhold tax at source. And finally, software bundled with hardware sold by the foreign supplier to the Indian distributor end users. Here, the Supreme Court has said that whilst there may be a component of a software involved in the hardware, this essentially pertains to the distribution, the resale of goods, and that's why it is not chargeable to tax in India. I've summarized certain key points from the Supreme Court's ruling over here. Now, one of the contentions that was raised by the department before the Supreme Court in this decision, and if you can look at the third bullet, the Supreme Court, the department argued before the Supreme Court that the taxpayers, because this was a consortium of cases, it's not only one company engineering analysis, there were groups of matters which were put before the Supreme Court. So the department's argument was that these Indian companies were also expected to do the, expected to withhold tax at source under Section 9. And friends, we all know that White Finance Act 2012, there were 3 explanations which were added to Section 916, which provided or which deemed the royalty to be chargeable to tax or deemed to accrue or arise in India in the hands of the non-resident with retrospective effect, right? And something which is some provision which is not under the law itself as on the date of doing a transaction, and then you few years later you bring a law or a provision or an explanation and introduce it with retrospective effect. So as on the date of undertaking the transaction, how is the taxpayer to know that there will be a withholding provision like this which will come in the future and hence I should be withholding? So the Supreme Court has once again laid down very categorically, much like in the Vodafone's case, that a person cannot be expected to do the impossible, which is to withhold tax, whereas, when there is no provision under the law, and the department few years later introduces a retrospective explanation. The Supreme Court has reiterated the principle that their DTAA provisions are beneficial to the taxpayer, if more beneficial than the provisions of the Act. And then finally, the last proposition that we discussed regarding the resale of goods. So friends, likewise, even how we discussed for the royalty aspect, even the fees for technical services aspect is an extremely complicated space. When we're talking about remittances from India to non-residents for their income, please do a careful analysis, threadbare study whether the payment for which you are, the payment for the transaction that your Indian client is making, does it constitute rendering managerial, technical, or consultancy services? There are plethora of decisions on this by the Supreme Court. You have your Kotak Securities, several decisions on this, which help you to understand what can and cannot fall under the ambit of Section 917. Of course, this is not a dedicated topic on Section 917, so I have not gone into all those decisions. I just wanted to refer to this engineering analysis because it's a very recent decision. But please do a threadbare analysis when it comes to analyzing under the domestic tax law. Now, under the DTAA, one needs to, when it comes to fees for technical services, it's a very interesting proposition under the DTAA. Many of the double tax avoidance agreement do not have a dedicated article on the FTS, right? Now, if there is no article on fees for technical services, there are ample of views that have emanated over time from the judicial precedents. One is that if there is no FTS article, which means this income is to be construed as a business income of the non-resident. And then you again go to your business article, which is Article 7. And it says that if you do not have a permanent establishment or a presence or a service fee or a fixed place fee in India, then the non-resident's income is not chargeable to tax in India, right? And this would majorly be the case. If let's say some company was going to provide you FTS, fees for, going to provide you technical services, its employees are based in the US and they are going to provide you some services online. They are never going to come to India and form their fixed base or spend any time in India, right? So if let's say the treaty does not have the dedicated article on FTS, then you need to go to the business article. If there is no P, not chargeable to tax in India. Some other view, other view which is possible is, if no FTS article, you go to the other income article under the DTAA and seek to tax it under the other income article. There again, certain conditions have been given. One needs to carefully analyze the respective article, of the concerned country's treaty that you are typically looking at. Now, friends, you would all know, but it is very important to reiterate that there many treaties like US, UK, Canada, Singapore have a make available clause in the FTS article or the FIS article. What this make available clause means is that in the process of rendering the technical services by the non-resident to the Indian resident, has it made available the knowledge, skills, know-how, processes? Has it passed on that information to the resident Indian so that in future, if the Indian resident wanted to do the same work on its own, will it be able to do it or not? So if the answer is yes, that yes, the Indian company will be able to do it on its own, then the non-resident has made available the technology, skills, know-how, processes to the Indian resident. And then the treaty says, okay, if technology is made available, if skills, know-how, knowledge is made available, then the payment which India is making to the non-resident will constitute as FTS under the treaty as well. If you cannot demonstrate, if it cannot be demonstrated that the knowledge, skill, know-how, processes have passed on from the non-resident to the resident, and next time when the resident requires these services, it will have to again approach the non-resident, same or any other non-resident company for availing these services, then you can conclude that there is no make available of the technology, skills, know-how, and under the treaty you can take a shelter under this make available clause and state that the payment which India has made is not chargeable to tax in India. Friends, again, as advisors, as chartered accountants to the Indian party, be extremely averse to this kind of provision. Be extremely sensitive, because what constitutes make available and what doesn't is changing over a period of time, right? If let's say you are getting the same type of services or training again and again and again from the same service provider for for one particular type of thing, after 10 to 12 to 15 instances like this, you may be equipped to do that work yourself, right? So it is continuously evolving. Please look at the transaction on a standalone basis, what constitutes make available and what doesn't is a very, very specific analysis that needs to be made, just for the interest of everyone. And this is how I've always told my colleagues to make the concept of make available understand it better. If let's say at our homes or in office we have an air condition, let's say that breaks down, and if we need to call a person to repair it, and that person comes and then does his work, takes the payment and goes away. Now, has he made available the technology or know-how or skill or knowledge to you? The answer is generally no, right? Because next time, if your air condition breaks down again, you will have to again call that same repairman or any other repairman to come and fix the air condition. So every time that your air condition breaks down and you need service, you need to call a repairman. And that is what is kind of very simple in a naive example of to explain make available for everyone's understanding. Again, under the treaty, under the domestic tax law, the withholding tax rate is provided at 10% under section 195 read with 237 capital A. Of course, it is increased by surcharge and cess. If the payment which is being made as covered as fees for technical services under the treaty, after you've analyzed all your make available and everything, then the withholding tax rate is 15%. However, there are some treaties which India has entered into where the rate is slightly different as well. But generally, it is 15%. Yeah. Friends, after we've understood, ascertained what is the income which is chargeable to tax under the DTAA, what is the income which could be chargeable under the treaty. Once we've determined the chargeability of the income to tax, we now come to section 195. Very important to read, and we'll read 195(1) for everyone's benefit. Any person responsible for paying to a non-resident, not being a company, or to a foreign company, any interest or any other sum chargeable under the provisions of this act shall at the time of credit of such income to the account of the payee or at the time of payment thereof in cash or by issue of check or draft or any other mode, whichever is earlier, deduct income tax thereon at rates in force. I've highlighted all the critical components in this section for everyone's ease of understanding. It's important to understand any person. So who all are involved, right? Any other sum chargeable under the provisions of this act. So it is not on remittance. It is on the sum chargeable under the act. Shall at the time of credit of such income. So it is saying in the remittance part, what is the component of the income? Then it is saying to the account of the payee or at the time of payment thereof, whichever is earlier. So it has withholding triggers at the earlier of the two events. Then it says in cash or by issue of check or draft or by any other mode. So any cash payments or even payments in kind are subjected to tax under 195. And then finally it says deduct income tax at the rates in force, right? The rates in force is a specific term which has been defined under section 237 capital A, right? There's a proviso given that in the case of a government or a public sector bank, the withholding will happen only at the time of payment. So they have been given that relaxation that it will not happen at the time of credit, but only at the time of payment. Now, explanation 1 again helps us to understand the wide ambit that the statute is trying to provide under 195. If you were to pass an entry in your books and say that I don't know the creditor as yet, or I'm not acknowledging my debt towards the creditor as yet, and even though if I credit the suspense account, still the provisions of 195 subsection 1 gets triggered, and I'm supposed to withhold tax in the favor of that party as on the date of credit to that account itself. An explanation 2, which is important, which was of course introduced after the Vodafone case, is that any person responsible for paying to a non-resident, and what they are doing is they are extending this ambit of any person to a non-resident as well. So now, by virtue of explanation 2, which was brought into as a clarificatory explanation, because the department, the statute uses the word and shall be deemed to have always applied and extends. So what they are trying to say is that this was always our intention. Now we are just clarifying it. So any payment by a non-resident to another non-resident will also form part of any withholding subjected under section 195. So friends, as we discussed in gist, once again, let's quickly go through the very important elements of this section. What is the scope? To whom does it apply? So it applies to any person responsible for making payment. Payer to include the non-residents as well. This explanation, which was essentially introduced to overcome the decision of the Supreme Court in Vodafone International, because at that point in time, the non-residents were not covered, that there was no section under the law to withhold. And one of the propositions raised was that impossibility of performance. Now, insofar as the non-resident recipient is concerned, so the section is very clear to say that any non-resident, which is not a company, and it also includes a foreign company, which is subjected to the withholding under 195. Now, if let's say there is a foreign company and which has a place of effective management in India, then it becomes important to understand. Then it becomes important to understand how will the withholding work. And in this regard, the CBDT has issued notification number 29 in 2018, and it clearly provides that the entire scheme of how the foreign company will be chargeable to tax in India in terms of availing depreciation, in terms of carrying forward their losses. And they also made a reference to 195, saying that the 195 applicability will continue as is in the case of any other foreign company, right? So this notification may be referred to, and it becomes important that when your Indian client is making a payment to the non-resident, you have to evaluate whether the non-resident has a POEM in India or not. And if they do have, then please, friends, go and read this notification number 29. It will give you some more clarity on how one needs to go about the withholding when a foreign company has a POEM in India. The deductee doesn't include a resident but not ordinary resident, that has been provided. And this is just a thought which I wanted to raise in front of everyone, that what would be the impact of this section 6, 1 capital A, which has been introduced last year. If, let's say, there's an Indian citizen who is a non-resident in India, of course, and is also not a resident anywhere in the world. Now, section 618 deems that person to be resident in India. Now, to what extent I need to consider this deeming fiction under 61A? Does this individual become resident out and out? Because this individual is typically a non-resident under the domestic tax law, right? And because he's also not a resident anywhere across the world, even if I wanted to give a treaty benefit, how do I go about giving the treaty benefit? Because I will not get a TRC in favor of that individual from any government, right? One would also have to look at the different aspects involved in the domestic tax law of the different countries that he might have lived in, in that last 1 year. He would have, of course, stayed very less, in each of the country, and that's why he's a non-resident everywhere, and that's why this 61A would get triggered. But just wanted to leave this thought with everyone. It's a thought-provoking one, may become applicable for individuals who are based in Indian citizens who are based in UAE, who are based in other tax-friendly countries where there is no corporate tax as such, and where they are not liable to tax. So that's something to think for all of us. Finally, what is the scope? What is covered under section 195? Any interest, except for certain exceptions which have been provided under the Act, because those are very specific sections which have been provided. So any interest or any other sum chargeable to tax, and this could be royalty, fees for technical service, dividend, capital gains, and so on. As we discussed earlier, salary income is not included. And friends, very important, there are no thresholds which have been prescribed. So even a nominal amount of remittance which happens from India to a non-resident, the same level of scrutiny and analysis is required as you would do for a typical large quantum which is being remitted. We discussed when it is to be deducted. Now, finally, we come to the rate of deduction. So the section provides that you need to withhold tax at the rates in force. Now, section 237 capital A, it talks about rates or rates in force when you are paying advance tax, and then when you are paying, and then when you are deducting the tax. So today we are concerned with the deduction side of it. So 237 capital A subsection 3, it typically talks about whenever you are wanting to withhold under 195, you need to adopt the rate specified in the Finance Act, of that particular relevant year, or you go to the rate as prescribed in the DTAA. So any double tax avoidance agreement signed by India with any country under section 90 or any jurisdiction under section 90 capital A, you go to that respective DTAA and look at the rates which has been provided under that. There is one more provision under the domestic tax law which says that higher rate of 20% is applicable if section 206 AA applies. Now, section 206 AA has become slightly irrelevant, and we'll come to that as well, simply because now the provisions of 206AA are subjected to Rule 37 BC. And if you want to take the benefit of that, you need to provide a TRC. The moment you provide TRC, you are any which way eligible to go under the treaty. But still, we'll discuss that a little bit in detail as we go ahead. Now, friends, very important to discuss these two decisions, which is the Transmission Corporation's.
What is?
Yes, ma'am. Hello. Okay. So these two decisions are landmark decisions and have helped settle a lot of controversy, in the 195 space. It becomes very important for us also as chartered accounts in our day-to-day practice. And friends, I would urge, please read these two decisions and quote the relevant points, relevant observations, relevant paras in the note that you are providing to your clients whenever they come to you for a opinion that whether I should withhold tax when I'm making this payment or not. And friends, when I say that they come to you for your advice, it could also be on a phone call, right? Arey sir, main TDS kaatu ke nahi kaatu. Whilst they may not pay you for, for your time and efforts, but please develop maybe a half-pager, one-pager write-up, which you can then, circulate it to all your clients as well. Please ensure that you are safeguarding yourself as well when you are giving an advice or signing off on 15 CB, because now it's our professional duty, it's our professional responsibility to ensure that we are taking all adequate care and we are doing all our diligence so that our professional onus is discharged adequately. Anyways, coming back to this decision, in this case of Transmission Corporation, it's dated, the decision was of 1999. The contention was, so Transmission had paid a trading receipt to a non-resident, right? And because the assessee's contention over here was that withholding under 195 needs to be done only in respect of the sum, which is a pure income from the entire remittance which is being done, and does not need to be necessarily withheld on the entire gross component. The department, of course, didn't agree to this, and the matter traveled right up to the Supreme Court. The Supreme Court has clearly laid down that the withholding is applicable only and only to the extent, from the remittance part, which bears the income character. Okay. So if let's say out of 100, partially the, partial amount from that 100 is also including or having an income component, withholding obligations to arise on that component as well. Insofar as any remedy to the remitter or the recipient is concerned, there are section 195.2, 195.3 and 197. We'll have a look at them in some time, but these are the remedies which are available to them if the payer or the recipient desires to approach the tax office and ascertain the right amount of withholding that needs to happen. So this decision was rendered in a positive sense, but the department picked up, paraphrased certain observations and has formed their own view that what the Supreme Court meant was that if there is a certain component of income character in the entire amount of remittance, tax needs to be withheld, right? And that's how 10 years later, even in the case of GE India Tech, the matter was there before the Karnataka. Sorry. Yeah. The matter was there before the Karnataka High Court, and the department, paraphrased their understanding from the transmission decision and placed that contention before the Karnataka High Court. Karnataka High Court agreed with that, and then finally GE India, argued before the Supreme Court. And that's what the revenue contention was. Okay. If there is a certain component which is chargeable to tax from the entire remittance, tax needs to be withheld, or alternatively, the payer needs to approach the tax authority for a nil withholding certificate. And where such certificate is not there, withholding is inevitable. And where the Supreme Court then laid it conclusively that if the payer is fairly certain that there is no income component from this entire remittance part, right? Or what is the income component from the entire remittance part, then the taxpayer or the remitter is free to go ahead on that basis, right? And not go ahead and withhold tax on the entire component. And friends, this becomes very important in our day-to-day practice. Let us take an example of an Indian client coming to you and saying that I want to buy a property, but this property is owned by a non-resident, right? So the non-resident will provide you the cost, provide you, because the sale consideration is being discussed as a commercial thing. But if you were to withhold tax on the entire sale consideration, the non-resident will object to you and he might not even go ahead with the transaction. The non-resident will tell you, that you please withhold tax only on the income component which I'm earning. Why are you withholding tax on the entire component, right? And that's where you will have to rely on this GE India ruling if you want to advise your client and say that, yes, look, whatever this non-resident seller is saying is correct. This is what the Supreme Court has affirmed. If we are fairly certain that this is what the gain component is, then we can withhold tax only and only on that income component. But friends, this becomes a little bit tricky as chartered accountants, because our advice will generally depend on which side we are advising. If we were advising the resident who is the buyer, we will say, be conservative. Why are you taking any risk? You withhold on the entire amount. Let that non-resident file return, claim a refund, and so on. If in this same transaction, we were to represent the non-resident seller, right, and we are talking to the Indian party who is the buyer or their chartered accountants, we will put forth a very strong argument relying on GE India Technologies case. Like, look, this is what the Supreme Court is saying. The Supreme Court is very clear. If the payer is fairly certain, and what data do you need to become fairly certain? I'm providing you my purchase agreement. I'm providing you all the details related to my purchase. You please index the cost, reduce it from the sale consideration which my client is going to receive from you, and then you pay me, and then you withhold tax and pay me the net amount. Why are you unnecessarily burdening me by withholding tax even on the cost element of this property? So same chartered accountant on any given day, depending upon which side you are representing and advising, you will take two different stands. But today we are here discussing the law, and that's why I gave this practical perspective on this point. So friends, even if let's say you are advising to the payer, please ensure caution, because the penalties or the onerous responsibilities that is there on the payer are extreme under the domestic tax law. And just for the sake of certain amount as which your client can be held to be an assessee in default for, we ideally would not want to get into all these sort of issues, right? But these two decisions extremely relevant. I would urge all of you to read it. Late last year, there was another decision in the case of Pilcom. Again, very large decision. It's actually not in the context of 195, but it is in the context of 194 capital E. The only point which I would like to raise over here is that the maybe not 100% correct decision in my view, but it said that under 194E, the payer, the remitter, cannot go and give the DTAA benefit to the recipient, because under 194E, it refers only to a flat rate of withholding, and it does not refer to section 237 capital A, which is the rates in force, from where you can actually go to the relevant schedule under the Finance Act for that year, or you go to the DTAA. So the Supreme Court held that 194E mentions a flat rate of 20%, and hence the remitter cannot give DTAA benefit, to the to the recipients. Now, in this year, just a few months back, the important decision of engineering analysis that we discussed earlier, in the session, that has distinguished Pilcom, and it has said that while Section 194 capital E does not talk about giving the DTAA benefit, but Section 92 that starts. The Supreme Court observed that 194E does not refer to chargeability of tax under the Act of the concerned non-resident assessee, and they distinguished the case of Pilcom to say that because 92 starts with a non-obstante clause, which means that if you provide a TRC, if the treaty benefits, the provisions of the treaty, to the extent they are applicable to the taxpayer, vis-a-vis the provisions of the domestic tax law apply. And Supreme Court relied on that, section 92 and said that it starts with notwithstanding non-obstante clause, so it overrides 194 capital E as well. And that's how it has distinguished the Pilcom decision given by the Supreme Court earlier. Now, a few other important elements that we need to understand to ascertain the any sum chargeable to tax. There was an instruction number 2, which was laid down and which stated that whenever, even if there is no application made by the remitter to the tax authorities under 195(2), the revenue will determine the appropriate or the proportionate amount which is chargeable to tax. And to the extent the payer has not withheld tax on the amount, on the income component which has been remitted, the remitter will be considered to be a defaulter, and accordingly actions under 2011A will follow. Also very important to understand the circular number 3 of 2015, right, which was issued in the context of section 40AI. So friends, if as you all may know, that if tax is not withheld on any expenditure, and then the department decides that the tax is liable to be withheld, the expenditure is disallowed in the hands of the payer, and in the year in which you actually deduct tax and pay to the government, that expenditure is allowed. This circular number 3 of 2015 also says that what is to be disallowed in the context of 40AI is also only to the extent of the income component in that remittance amount. Because what does the section say? That to the extent of tax not deducted. And on which amount is the tax liable to be deducted? So that is only the income component in the entire remittance amount. So that is why this circular is also very handy, where the disallowance that should happen under 40AI is to be restricted only to the income component under the or the appropriate proportion of the remittance amount. So just to sum up, friends, entire payment not chargeable to tax, no withholding. Entire payment chargeable to tax, yes, tax needs to be withheld. Part payment chargeable to tax, exercise caution, withhold on the proportionate amount of sum chargeable to tax only and only if you are fairly certain about all the components of cost that you are allowing as a deduction. If in doubt, deduct. Please don't take any risks, because the onerous responsibility will come on your client, who is the payer. Insofar as applicability of rate is concerned, we've discussed this, that the rate specified in the Finance Act or the DTAA, whichever is beneficial, will apply. Higher rate of TDS under 206AA if PAN is not furnished, which has been relaxed by Rule 37 BC now. So if you provide those 4 pieces of information, which is your name, email ID, address, TRC, tax identification number, communication address, and so on, then you will be granted a relaxation under 206AA, and the higher rate of 20% will not apply. Then the Rule 26 provides as to what is the exchange rate that one needs to adopt whilst computing the withholding tax amount that needs to be deducted on the remittance amount. So it's the SBI TT buying rate, telegraphic transfer buying rate, on the date when you are obligated to withhold tax, right? That date needs to be considered, that rate needs to be considered, and it has been provided that any fluctuation between the date of deduction of TDS and the remittance has to be ignored. Again, there are a lot of transactions, friends, where we see a grossing up of tax that happens in the hands of the payer. This is generally the case when we have a very large non-resident recipient, and they say that we are tired of your Indian tax litigation, we don't want to get into it, we are just concerned with our net amount that should come to us. What is your tax obligations in India? What tax you need to pay? We don't understand that. We don't want to get into that. So you pay us our $10,000 and you take care of the tax at your end. So friends, in this kind of situations, there is a need for grossing up the tax component, because what happens is the payment which you are making to the non-resident, which is net of tax, right? Which is that $10,000 will be considered to be net of tax payment, and hence you need to gross it up. So if let's say the tax rate is determined to be 10%, right? And I'm just taking this for hypothetical illustration purposes. Then that $10,000 which you have remitted becomes 90% of the entire consideration, because ideally you were supposed to remit 100, but 100 में से 10 was tax, and then you pay the person balance 90. So this $10,000 becomes 90%, right? Then you gross it up by gross it up by 10%, and then you come to the to the grossed up amount, and the tax which you will pay to the government will be then on your account. So I have given an illustration for that as well in the following slides. Now, friends, we discussed this MFN clause and the beneficial ownership clause, and very important again for us to understand these two concepts. So friends, MFN clause is favorable terms in a DTAA in respect of an income stream which is subsequently granted to a third country by a particular country, and which needs to be extended to the existing treaties with the other countries. So what does this mean is that let's say India has entered into a treaty with Netherlands, right? And there is a certain withholding tax rate on the dividends or FTS. Okay. Now, few years later, another treaty, India signs another treaty with another country. Now, Netherlands, because it is always averse that after giving a certain rate, India might go and give a better rate to some another country, and that might hamper my trade and my commercial activities with India. So what it says is, look, India, if you were to give a better withholding rate of dividend or FTS to some another country tomorrow, right, you better give that rate to me as well. So this is called as a most favored nation clause. That today, if let's say India-Netherlands treaty has a 15%, as a 5% withholding tax rate on 10% withholding tax rate on dividend, but Netherlands is saying that if tomorrow you give someone nil or 5 or 7.5% withholding rate on dividend, then I want this MFN clause activated in our treaty, and you will also pass on that 5%, 7.5 or nil, whatever is that you have agreed with that another country, that withholding rate applicable to my residents as well. So it's some of the treaties which India has entered into has this MFN clause. India, Netherlands, India, Hungary, India, Belgium, India, France are some of the examples, right? MFN clause is generally prospective. So what it means is that if let's say India Netherlands treaty was entered into in let's say 2000 hypothetically, and then India enters into a subsequent treaty where it is giving a beneficial dividend rate, and let's say that treaty is entered into 2005, then this MFN clause gets triggered only from 2005. So you cannot claim the benefit of this MFN clause for the year 2000 to 2005. Thereafter, whatever dividend is being paid, if you fulfill all the conditions, MFN clause will get activated, and you will be able to take that lower withholding tax rate even in the case of a India-Netherlands treaty. Either it's a lower tax rate or the scope of income is generally restricted or limited under the MFN clause. Now, friends, after you've read the treaty, right, it is also important to read along with the treaty the protocol, the exchange notes, which the two countries have also agreed and have listed down as a public document. And generally the MFN clause and everything, all the details to that will be listed down in the protocol or in the notes. Now, how does this MFN clause work or get triggered? So there are different ways. It's a bilateral, DTAA is a bilateral agreement. So it depends on how the countries have agreed to it. It could be an automatic trigger. It could be a trigger by way of notification, or it could be a trigger by way of a subject to negotiation followed by notification. So depends upon country to country, how has the countries agreed upon in terms of how they want the MFN status to be activated. Friends, in the interest of time, I'm not going into this decision of concentric services. It's again a recent decision, and that's why I have brought it up over here. The limited point here was there was a payment being made from on account of dividend from India to a Dutch company, Netherlands company. They made an application to the AO that we want the lower withholding rate at 5% in light of, after activating the MFN clause, because India-Slovenia treaty, India-Lithuania treaty also has a withholding rate of 5%. And whilst they are being given that 5% rate, we want the 5% rate in the case of a Netherlands recipient as well under the MFN clause. The matter, that order, that application of lower withholding was rejected, and against that a writ has been filed. A writ was filed before the Delhi High Court. A very good decision, very educative, very, very informative as well. Please go through it at your convenience. I've given the citation as well for everyone's reference. Now, apart from MFN, another aspect that one needs to consider is the concept of beneficial ownership. And friends, why all these concepts become important is that when you are giving anyone any treaty benefit under the treaty, now it is not just as simple as that you get a Form 10F, a no PE declaration, TRC, and then that's it, right? And then you go under the treaty, make the payment at a lower withholding rate, or if the treaty benefits provisions are beneficial, you do not consider it for withholding purposes, and your onus and your professional responsibility is done. No, it doesn't work like that. In this era of MLI, in this era of GAR, all these things require adequate diligence from our end. One of those important aspects is the evaluation of beneficial ownership. Now, many of the articles under the treaty, like your interest, dividend, royalty, they provide that if the recipient of the income is not a beneficial owner, then you cannot give the benefit of that article under the treaty, and you might actually have to look through and go to the ultimate beneficial owner and look at that treaty, right? So let us understand what does this term beneficial ownership mean, and the different authorities across the globe have defined it in different manner. So you have your IBFD understanding of the term beneficial ownership, your OECD model convention, your US model convention. Professor Klaus Vogel in his commentary has defined it in certain manner. Even under the domestic tax law, friends, if we look at section, for dividend under 2 subsection 22 or section 79, we find references to the term beneficial owner, which again, gives an indication of how the Indian statute or the Indian authorities think of this term beneficial ownership. So just to quickly discuss a couple of them, the OECD model convention, it says that the term is to be used in a purposive manner, right? It is to be used with the objects in which the convention, the DTAA, has been entered into. And it is very clear that conduits or shell companies or agents or nominees are not to be regarded as beneficial owner. If you look at the US model convention, they define beneficial owner as a person, that person will be the beneficial owner who is going to be attributed that income for tax purposes as a resident of the United States. So that's how their model convention treats this. Professor Klaus Vogel's definition is simply, is simple and simply the best. He says a person who is free to decide. Now, once you have received that dividend, right, and now I'm talking about as a non-resident company, am I free to decide what I want to do with that dividend? Am I free to decide where I want to, apply that money? If yes, then yes, I am the beneficial owner. But friends, if you know how these international structures work, you would have an ultimate parent sitting in UK, US, Canada, and they would have an intermediary holding company to enter into a jurisdiction like India. So let's say their intermediary holding company is in Singapore or Mauritius. By a back arrangement, or by virtue of their articles, or by virtue of a board resolution or a contract, this dividend which Mauritius would receive from the Indian company would pass on from Mauritius to the ultimate parent, let's say for example on the very next day, right? And then money is actually not under the control of that Mauritius company only, because it is contractually obligated to receive the money and pay it to the ultimate parent within the defined time frame. So if you want to understand who is this beneficial owner when you are advising your client on whether the recipient is a beneficial owner or not, please do some due diligence. Please ask some questions. Please try and understand whether the recipient is indeed a beneficial owner or not. Because all these things again determine whether while making the payment, you can become eligible to avail DTAA benefits or not. This first point we've already discussed in bits. It's because 206AA overrides rates prescribed under the DTAA. So we have got decisions now which clearly say that no, section 92 will prevail, and the DTAA rates will override the 206AA rates as well. And we've got ample of decisions on that. I'm not stressing too much on this because it's fairly settled now. That's why, in the interest of time, I'll move ahead. Crossing up is something which we have already discussed. Now we come to the remedies that are available to either the payer or the recipient of the income, because you've done all your analysis, what is chargeable to tax, how rate is to be withheld, so on and so forth. But let's say if the resident, if the remitter believes that no, there is a certain component which is not chargeable to tax. However, the remitter doesn't want to take the risk of falling short of withholding and then finally getting caught under 2011A, becoming an assessee in default, so on and so forth. Then the remitter can actually approach the income tax authorities and make an application to say that I believe that the entire amount is not chargeable to tax. So you please determine what is the right amount which is chargeable to tax and provide me with an order to withhold tax either at a lower rate on the entire amount or the specified rate only on a certain income component of this entire remittance, right? So for this, it becomes important that the remitter has all the information available with him. So for example, if let's say you are entering into a proposed transaction for purchase of residential property, now the seller should be willing to share with you the purchase agreement, right, at the time when you had purchased the property, and certain other evidences that you would require as a part of your own due diligence, and then submitting an application to 195(2), making an application under 195(2). Because if you would not provide that information to the officer, how will the officer determine what is the income component in that remittance part, right? And then there is this entire rule which has been laid down that under which form the application needs to be made, how is the form supposed to be verified, and who all what are the components that the assessing officer needs to consider while deciding or disposing of the application, whether the person who is applying has whether is there a tax payable on estimated income, what is the tax situation for the last 4 years, is there an outstanding demand, is there any existing liability under the Act, Wealth Act, so on and so forth. Right. After verification, the assessing officer will provide a order which will be for a specified period, and then once that specified period is about to end, you can apply for a renewal as well. Similarly, under 195(3), now it is the recipient who can go and approach the income tax office. Because as I mentioned in my example, there may be certain documents which the non-resident doesn't want to share with the Indian party. They may be confidential, they may be sensitive, or for whatever reason. So then if the non-resident wants that the resident remitter doesn't withhold tax on the entire component, the law has also provided a remedy to the recipient as well under 195(3). But this section is very important to understand. It's slightly different from 195(2). While under 195(2), the tax officer will determine the appropriate portion of sum chargeable to tax, right? And that's how the assessing officer may give a lower withholding order or something like that. 195(3) very categorically states that is this certificate can be issued only without deduction of tax under that subsection. So only when the recipient believes that the entire amount is not chargeable to tax can he make an application under 195(3). If let's say the recipient wants to approach for a lower withholding tax rate, right, then the recipient will have to approach the tax officer under 197 I do not believe under 195(3) the officer has a power to issue a lower withholding order to the resident, to the non-resident recipient, right? So this is just that one distinction between 195(2) and 3. Now again over here there is a rule which has been provided. There are forms which have been listed down. Form 15C applies to banking or insurance company not being an Indian company carrying on business in India. 15D is for any other person who carries on business or profession in India. And there are certain conditions to be fulfilled by the non-resident, who can then make an application to the tax office. So these are all quantitative conditions, and one would need to look at your non-residents clients' facts, and if they are fulfilling these conditions, then that application under 195(3) can be made. Now, friends, on the first day, one of the other speakers has already dealt with overview of MLI, and I'm not going into this purely from an MLI perspective, but certainly I would like to spend some 5 minutes on, how does MLI come into the picture now, and how does it impact the 195 withholding. I just want to check with the organizers till what time can I, extend my talk.
Sir, 10-15 minutes we can go, sir.
Okay, many thanks. Many thanks. I'll wrap it up in the next 15 minutes. Okay, so friends, overview of MLI, I believe Naman has already dealt with it. So I'm not getting into all that. But this is what, the MLI impact on 195 is. So see, friends, if in cases where MLI is still not applicable, then you would, go about your 195 business like before. Read the domestic tax law, evaluate, read the treaty, evaluate, and then, based on whatever documentation requirement is given under the domestic law, which is no P declaration, TRC, Form 10F, etc., you will take all those forms on record and then go ahead with your withholding. However, now when MLI is applicable, right, and there are certain minimum standards to MLI, one of them being the principal purpose test. Okay, you can give a treaty benefit now when an MLI is applicable to a particular treaty. So now what one needs to do is read the domestic tax law. Okay, then when you read the DTAA, you have to read the DTAA along with the MLI, and that's when you will see that if the MLI is applicable, which means the principal purpose test is applicable, and if that non-resident doesn't fulfill the principal purpose test, the provision actually says that you cannot give a treaty benefit, right? So one needs to think that now to what extent is the payer's obligations and responsibilities are, right? And just to draw a reference, I have reproduced one para, an extract from the para from the Shom Committee's report in context of GAR, right? So it says there is a responsibility cast on the payer of any sum to a non-resident under the Indian tax law in the form of withholding agent of the revenue, as well as representative assessee of non-resident payee. So they are making us, as a resident remitter, we become an agent of the non-resident under Section 163 of the Income Tax Act. But the report clearly acknowledges that though it is issued in the context of GAR, where where the main object is to avoid tax, whereas under the PPT, any purpose to avoid to obtain the tax benefit under the treaty without having any commercial or any reasons to have that structure in place. So under the PPT doesn't even have to be the main objective. It could be one of the objectives of setting up, and still PPT could get invoked. So this just tries and shows, this just shows us the responsibility or the the onus that is now cast upon the remitter to evaluate what sort of structure that the non-resident has set into at the time of making the payment to the non-resident. Now it is very difficult, friends. It is easier said than done. Which non-resident is going to share the genesis or the reason of their particular structure? If we ask beyond 5 questions, which they may not even render services to us. So all these things are very practical. One needs to balance it, and as chartered accountants who are advising, giving an opinion, signing Form 15CB, Very important for us to take care of our responsibilities as well, right? Because if, let's say, you were to not take everything into cognizance, there are adverse consequences in terms of treaty benefits being taken away. There will be disallowance of expenses under 40AI. There will be interest and penal consequences. And as I just shared a while earlier, you could also be regarded as an agent or a representative assessee of the non-resident, and tax can be collected from you as well in that capacity. These are just some key select articles under MLI where if under these articles, if because of these articles, the payment that you are making may require some extra deliberation, some extra analysis at your end. So if there is a dual residency of a particular non-resident, the Article 4 of the MLI states that till the time the competent authorities are unable to resolve this, treaty benefits are not available. Now, if, let's say, I'm making a payment to a UK company, and that UK company also has some, let's say, a presence in Australia. Now, how am I to know that what is the outcome going to be between the UK and the Australian competent authorities when they are deciding where is the residency of that UK incorporated company? And I am only obligated to look at the India-UK DTAA read with the MLI. So a lot of practical nuances issues will come up as we go ahead in this. Similarly, for all the other articles, there will be deliberation analysis that will be required to be done at our end. Of course, in the interest of time, I'm not going into all these things, but this is the way forward that I wanted to share with everyone. What we need to do is we need to do a detailed matching exercise, that if India has selected a particular article, has that other country also selected that particular article in the same option that India has selected? If yes, then that provision of the MLI becomes applicable. You may also refer to the synthesized text which the CBDT has published and issued on its own website. Friends, please remember, synthesized text is not a legal document. It is just a persuasive document which can help you to understand how to read the DTAA after the MLI. However, it is not a legal document and cannot be resorted to or say that this was CBDT which has written in the synthesized text, so that is CBDT's view. No, we will not be able to take that position. We need to maintain robust documents so as to safeguard the position of the payer. We need to take all the indemnities, declarations, confirmations from the non-resident recipient. Now, friends, declarations can be obtained, of course, along with TRC, which is the basic document, but you need to obtain any opinion, any confirmation declaration from the non-resident insofar as their structure is concerned, whether they have got a chartered accountant, a CPA's opinion or a legal opinion which says that, yes, because of these reasons, we believe that the structure is not or will pass through the PPT test. A declaration is required in the context of the recipient being the beneficial owner of that particular asset or income. Also on the dual residency front and the permanent establishment not being there in the third state. So we need to put all these declarations, put all these points and get it signed by the non-resident on their letterhead so that your Indian client is safeguarded from the onerous responsibilities that flow along with non-withholding and the non-deduction. One very important element which has come up in this last few years, whenever transactions of purchase and sale of shares are happening, and you look at all these large deals that are happening, indemnity has become very important. So if your client is doing a fairly large transaction and the non-resident is not willing to accept any withholding, please ensure that you, of course, you would first evaluate and want to withhold. But if, let's say, that is not possible, they are taking shelter under a treaty, you are also fairly convinced, but still, please take appropriate declaration and also take appropriate indemnities. And the indemnities should be, for a substantial period of at least 6 to 7 assessment years from the date on which the, this transaction is consummated. It should at least be covering the income tax, the interest, and the possible penalty. And you, in that indemnity, you also need to cover the costs which will be incurred to defend the position. These indemnities are extremely critical. You need to have a lawyer along with you who can help you draft this indemnity. But it's a piece of advice that you should give to your client and ensure that they have that indemnity in place before the transaction is consummated. I have just put these two screenshots on the, in my PPT for everyone's reference. So the OECD website itself gives you the MLI matching database, and I've put the link at the bottom of the page so that, those who are interested can have a look at it later on. And you just need to put the two countries at the top, and then they give you this entire matching, it's a tool which they have developed, which clearly says, so Article 3 doesn't apply, Article 4 wouldn't apply. So the dual resident entity article, for India, Singapore doesn't apply, but for India, UK, it does. So, this is a very interesting and a very useful tool that OECD has developed. Friends, I would urge, please keep this link handy. Whenever you are now processing any payment to a non-resident, please go to this link, go to this website, look at the updated matching database between India and that other country, and then decide whether you can extend DTAA benefit or not, read with MNI. Similarly, I've just put a screenshot over here as to how does a synthesized text, a CTA, covered tax agreement look now. So this is India UK, synthesized text of the India UK CTA. And if you see at point number 3 below, it is saying replaced by paragraph 1 of Article 4. And then what is that paragraph 4 has been reproduced below in the box. So now you need to read the DTAA as 1 and 2 from the erstwhile DTAA, and paragraph 3 will be the paragraph which is there in the box. So that's how you need to read a DTAA, along with the MLI, which is now a covered tax agreement. So again, I've given a link, to this particular, page. Please, friends, go through it, understand how these things work post the MLI era. Some procedural aspects very quickly. These are the date, when this compliances need to be undertaken, when is the return that needs to be filed. I've listed down everything over here for everyone's convenience. Now, finally, friends, just to reiterate, whenever you are processing any remittance, these are the steps in my view that one needs to take into consideration. You will need to file a form 15CA CB. It's an online form. 15CA is of course to be filed by the company itself. And the 15CB is a certificate which a chartered accountant needs to issue. 15CA has multiple parts: Part A, Part B, Part C, and Part D. Different parts, are where income remitted is less than 5 lakhs but not chargeable to tax, where income is being remitted pursuant to a 195(2)(3) or 197 order, where income is chargeable to tax and exceeding 5 lakhs, and where income is not chargeable to tax at all. So different sections have been given under 195. I've covered that in my slide for everyone's reference, but those are fairly simpler ones, friends, and that's why I'm focusing more on the onerous part that comes along with issuing a 15CB certificate or advising a client in respect of a non-resident. You will of course obtain the TRC, the Form 10F, the indemnity and declarations as we considered, along with any other, your typical no PE declaration. You would now also want to obtain declarations, read with, under the light of the MLI. And now, if let's say the non-resident was to say that, yes, I have a PAN in India, then please obtain, a self-certified copy of their PAN. And if they say that, no, we do not have a PAN in India, so in order to extend the DTAA benefit so that the higher rate in 206AA doesn't apply, please obtain those 4 pieces of information as listed down in Rule 37 BC. So this is what I've just listed down over here. What does Form 15CA constitute? How does it need to be filed? There are 33 specified transactions and the remittances by individuals under the LRS limit, which have been specifically excluded from 15CA, 15CB requirements. Friends, many years back, there was a time when even every import payment required these forms to be filed, and it was becoming a very mundane job as chartered accountants to keep on issuing these forms again and again. Rightfully, now there are these 33 transactions where, you're not required to issue any 15CB or 15CA for that, which essentially includes a lot of very standard transaction on capital account, on imports, and so on and so forth. This this we've discussed, but let me just take a couple of minutes over here. Section 94 it provides that a non-resident will not be entitled for DTAA benefits unless he obtains the TRC from the government of the country of residence. Right? This essentially TRC is a tax residency certificate. It certifies that the applicant who is applied for the TRC is a tax resident of that particular country. Right? TRC is to be obtained by all the categories of taxpayers. There is no exception to that. Insofar as the Indian income tax law is concerned, Rule 21 AB1, it provides the information that needs to be furnished by the non-resident in the Form 10F. Now, whether a TRC is a conclusive proof of the tax residency of the particular non-resident or not has been up for contention quite a number of times, despite there being a Supreme Court decision in Azadi Bachao, a CBDT circular, in 789 of 2000, which have clearly laid down that, as a remitter, when I have received a TRC from the non-resident recipient, I will rely, because that's a document, that's a certificate issued by a government, by an tax authority of another country. And for me as a remitter, I cannot go and sit in the tax office's place and try and examine so much in detail. Once I have been given that certificate, it's a conclusive evidence, documentary evidence for me that that person, non-resident, is a tax resident of that particular country. However, if let's say that for whatever reason the TRC cannot be made available by the non-resident recipient, it could be on any account. It could be on account of COVID. It could be on account of any external factors which is beyond the recipient's by the non-resident's control. Right? We have a recent decision in SCAPS Industries which has said that if for whatever reason the TRC cannot be obtained by the non-resident, and you will have to demonstrate all those circumstances as to why you cannot obtain, right? Then this tribunal holds that the non-resident cannot be asked to do the impossible. And as a payer, what I will have to then do is rely on alternative, corroborative, supplementary documents and certificates to establish that yes, the non-resident is a tax resident of that particular country. This is again a fact-specific exercise prone to litigation, but one would believe that just because the TRC is not made available for not lack of trying, but on account of it being impossible to obtain, that's when the treaty benefits simply should not be denied on that account. Just maybe some thought on this. It's a fact-specific, but you could try and obtain the certificate of incorporation of that non-resident, place where the board meetings are conducted. You could look at their financial statements, their tax returns. This could give you a brief idea as to where the country is typically a resident of, right? But again, a lot of declarations and confirmations will have to be taken from that non-resident if they are not able to provide the TRC. And based on this decision, if someone wants to take a view, it is possible, but it is certainly prone to litigation. So, friends, we've already covered this in the earlier slides, but I've put this down very specifically. So, if tomorrow you are, asking your Indian client to take a confirmation or take an indemnity from, from the non-resident, please include all these points in your declarations so that your client is completely, covered and protected from any potential exposure that can come up. And you also, as an advisor to the client, have laid down the entire picture, the entire landscape before the Indian, before your Indian client, because you've evaluated everything in terms of POEM, PE, principal purpose pledge being fulfilled, beneficial owner, so on and so forth, right? So along with your TRC, no PE declaration, please also obtain confirmation declarations on all these points as well, right? We've discussed this in bits and pieces that if there is no withholding which happens under section 195, then there is a disallowance of expenses. Instruction number 2 of 2000, circular 3 of 2015, the disallowance only to be done to the extent of the income chargeable to tax. Similar disallowances are there under 40A IC and 40A3. The most important is being treated as an assessee in default and attracting interest and penalty consequences on account of non-withholding, and also being treated as a representative assessee, as agent of the non-resident. And friends, these are some, the other provisions that I was asked to cover. These are fairly straightforward, nothing complicated in this. It's a very specific code for limited purposes. Under 196 capital A, there are certain types of income, interest in respect of mutual fund, or interest received from specified company referred to in 1035. There are certain exceptions which is given. When is the trigger event in case of making this interest payment? So the tax happens at credit or payment, whichever is earlier. There's a withholding tax rate which is provided. Likewise, under 196 capital D, income in respect of units purchased in foreign currency or by way of capital gains arising from transfer. Again, the trigger event and the withholding tax rate has been provided under law. I have reproduced that over here. Friends, the only difference is under 196 capital D, the law itself provides that either it will be a flat rate of withholding 20%, or you could also give the benefit of the DTAA to the non-resident. And that amendment has been specifically included White Finance Act 2021. So this is a recent amendment which has come into under section 196D. So now if you are looking at 196D, the section itself tells you either withhold at 20% or go under the DTAA. And if that rate is beneficial, subject to you are being allowed to take the DTAA benefits, please go and deduct at that lower rate. But anyways, friends, we discussed in the earlier part, there is a case to be made that because section 92 is a notwithstanding section which says that the provisions of the DTAA are beneficial to the assessee to the extent, they are more beneficial than the provisions of the Act. That argument can be relied upon and be said that, whilst 196 A, B, C, we are still eligible to take the treaty benefit, but that view is certainly prone to litigation. Friends, with this, from my end, I am done with this talk. Once again, this is a very practical topic. We as chartered accountants face this on a day-to-day basis. Please don't treat 15CB as a mundane compliance. Filing of Form 15C as a mundane compliance. Things have changed with the MLI and the GAR coming into the picture. There are very, very onerous responsibilities on us as advisors as well when we are signing off on the certificate, as well as a professional responsibility while advising to our clients. Please take due care. Consult some senior professionals in the field. If there is a certain type of a transaction that you believe or you are not confident of, please take recourse to 195.2, 195.3, 197 as the case may be. If the amounts are fairly high, let's say in the case of an immovable property, tell your client to plan the transaction in advance so that you are left with enough time to approach the department, take the necessary certifications, so on and so forth. So, friends, these are all topics that one needs to, one needs to handle it practically on a day-to-day basis. We've understood the law, we've understood the nuances. Each transaction will come up with its own specific set of challenges, and that's how we will be able to, deal with this topic as we go ahead. I would just like to check with the organizers if you want to take any questions, or because I know we are, almost half an hour past 9:30 time, and we want to start with the second session.
Thank you so much, Karthik sir. There are few questions in the chat box. If you can go through them, and if you find relevant, which were not covered in the presentation, we can take it. Otherwise, okay. We have created a WhatsApp group wherein all the participants are there. Karthik sir, we also request you to kindly join that group. We will add you to the group.
Sure.
So if furthermore there are queries, the participants can definitely put it in the chat.
Absolutely. I'm also sharing my email ID, which should be now on the screen.
Yeah.
So if people want to write, also, I'm fine. I'll be more than happy to answer. Let me just take a couple of questions which have come up.
Right.
So kindly take up grossing up at the rate of 20% under 206 AA slide 24. Ma'am, that works in the same way as we discussed. So let's say I'm making a payment of $10,000 to the non-resident, but I am getting covered under 206AA because the non-resident doesn't have a PAN, they are not providing me with TRC, so I am not able to give them the relaxations under Rule 37BC. So this $10,000 will actually become 80%. Please remember, under 206AA, it doesn't have to be increased by surcharge and cess. Like how you would typically increase any domestic, withholding tax rate with surcharge and cess, which have been prescribed in any other section of the law. Under 206AA, 20% is absolute. And on that also, I've relied on, I've put decisions which are, saying that. $10,000 becomes 80%. You enhance it, you cross it up by 20%. So 12,500 then typically becomes your 100%. You withhold 20%, which is $2,500 that you pay to the government. And then the balance 10,000 is paid to the non-resident. And that's how you will undertake all your statutory compliances thereafter. So hope, ma'am, that answers.
Yeah, because you put it in slide, so I got confused. That's why I asked
No
whether
problem.
there is no crossing required for 20%.
No. Yeah. I'll just take another question which has been raised. Can we issue 15 CB considering 5% withholding on dividend to Netherlands? So a very interesting question. See, there are a lot of intricacies which are involved, and I have referred that decision of concentrics of the Delhi High Court disposing of the writ petition. Please read that decision. There are so many points which are subject to interpretation, and as chartered accountants, whilst we may interpret the law, we are certifying at the end of the day, right? So you may want to take the entire gamut of factors into consideration and then evaluate what sort of risk you and the client are going to face on account of the department not then subsequently accepting this lower 5% withholding on account of the MFN clause vis-a-vis the 10% withholding rate which has been given in the India-Netherlands treaty itself under the dividend article. If let's say tomorrow this concentrics is actually going to become, the department is surely going to challenge it before the Supreme Court. And let's wait for the Supreme Court unless and until we don't have a conclusive provision under the law or Supreme Court has not opined on it so as to make it the law of the land. I would refrain Mr. Bansal from, issuing any such certificate unless it's a jurisdictional high court against the department has not gone into the Supreme Court, right? Then you may still take it. But if it is another high court which has rendered certain decision but not in your jurisdiction, to issue a 15 CB basis, that would be slightly tricky, on that front. So,
sir, here can't we evaluate the MFN clause if it does provide and we are sure, right? As you said in the case also, they have agreed to it. Whatever is the Supreme Court, finally it will go by what is the MFN clause, right?
Yeah.
So,
but there are a lot of factors. So, for example, in this case, whilst the India-Netherlands treaty was already into existence, and there is an MFN clause, India entered into a treaty with Slovenia in 2005. Okay, and the protocol between India and Netherlands states that if subsequently a DTAA is entered into with a country who is a OECD member, so the word used is a member of the OECD. Okay.
Yeah, okay.
Now Slovenia के साथ treaty enter हुआ 2005 में, but Slovenia became member of the OECD in 2011. So what is the Indian department's contention is that मैंने जब Slovenia के साथ DTAA enter किया था, I didn't know it is going to become a member of OECD. Whether to become a member of OECD or not is a sovereign right. Every country has its own wish whether it wants to become or not. So at that time we entered into a DTAA with Slovenia. We didn't know it was going to become a member of OECD. But in the India-Netherlands, it is written as any country who is a member of OECD. And and Delhi High Court has analyzed the word is what kind of function is in the English.
Sir, actually this is I think not a matter which we can decide, but certainly
that is why
that intention is to go, because then India should put something in the Slovenia, this thing that we may have to relook into your DTA if you become the member of, OECD. Something
Correct.
that should be
Correct.
there.
So ma'am, in the Netherlands,
Yeah.
once this happened, Netherlands has already come out with a notification regarding its own MFN interpretation post, India, Slovenia, DTAA and all. India has still not come out with a notification. So that's where our authorities are still, maybe taking a wait and watch approach or whatever it is. And one comment by Mr. Nayak over here, please ask the foreign entity to file an application under 197 for lower tax deduction certificate. So fair point, sir. In that, the writ was filed against the, the department poshing, the application for a lower withholding made by these two companies. They had applied for a 5% withholding, but the department said that, it will continue to be at 10%. And yes, exactly. That is why they have filed a writ in the Delhi High Court against which the order that we are discussing here, Mr. Nayak. So fair point, appreciated. I think, organizers, Saket ji, if...
Sir, a question tha. If you see, I had a few cases wherein we are sure that there is losses in the property which we have sold by non-resident to the Indian. Even the tax department, they have come up with this 3% thing, and they make you to make payment of 3% plus the cess or surcharge. And second, sir, now when you remit from your own account to overseas, they are making this levies of 3% or 1%, etc. How does that impact, because what we are finding is that people are remitting in India. What people prefers is to make you the payment in NRO account, and then we transfer it to NRE account. So we are getting double deduction withholding tax,
No, so ma'am, it doesn't matter whether you are paying to the NRO account or the NRE account. The moment if you are paying to a non-resident Indian, an individual in their NRO account, the liability continues, the 195 liability still continues as is, because it doesn't mention that the money needs to be paid outside of India. The money can be paid even in the NRO account, and 195 withholding would still continue to apply. Because where it is being paid is irrelevant. So that's point one. And when you are finally remitting from NRO to NRE, so that's that non-residence issue, right? But just to answer from that front as well, if the non-resident transfers the money from NRO to NRE account, and if it can show the documentary evidence, look, this is my tax paid funds, this is my own funds now on which tax has been discharged, the bank will transfer the money without payment of any further taxes, because then it's a remittance of capital and it is not a remittance of income. So documentary trail will have to be provided, certainly, no doubt and no questions about that. But if you do this, we have had ample of cases where we have remitted money without any issue. So, yeah.
Thank you so much, Karthik sir.
Thank you
for
so
wonderful deliberation. Friends, I request kindly note down the email ID of Karthik sir, as well as we are adding Karthik sir in the WhatsApp group, so you can raise the query there itself. Friends, it's time to move to our next session, and it is our privilege to invite CA K. Sudarshan sir from Chennai. He is going to cover tax treaty dispute resolution mechanism. Sudarshan sir, immediately I request you to kindly take over the charge, sir.
Yes. Thank you. Thank you, everyone. Thank you, Akshay.
Thank you so much, Karthik.
Thank you, everyone, for a very patient hearing and great opportunity to share my thoughts. Thank you again. Sudarshan, all over to you. Thank you.
Thank you, Karthik. My screen is visible.
Yes, visible.
Good morning to all. Slightly detailed session from Karthik, but one thing I'm sure
Sir, have you joined from two devices? Your voice is echoing.
No, only from one device.
Okay, your voice is echoing, sir.
Is it okay now?
Yeah, please, sir.
All right. One thing that emerged from Karthik's discussion, if you could see, the kind of issues that Karthik touched upon, the fundamental fact is, he kept stressing on the fact that how cautious we need to be, while doing a 15 CSCB or, the kind of issues that has been encountering. So obviously, one would definitely think the possible solution is, this is going to end up in some sort of a dispute. And one of the reasons for having this particular session on tax treaty dispute mechanism is this is seldom being utilized. And today this is in a completely different revamp. So that's why I'm going to call it as MAP 1.0, MAP 2.0. And in a scenario where not only our domestic dispute mechanism has gone for a change in terms of faceless assessment, etc., including the tax treaty dispute mechanism, it has gone through quite a lot of overhauling, which is something which, as professionals, I think we should definitely consider, going to more often to, to create a sense of bring the amount of certainty back into taxation. And more importantly, I feel, there's plenty of scope for professionals like us. Tomorrow if arbitration or mediation comes in, I always believe, barring both the chartered accountant as well as the lawyers had undertaking a lot of international commercial arbitrations as well as investment arbitrations, I believe we chartered accountants are well equipped, well possessed to handle arbitration mediations in a much better fashion. In fact, when I do a lot of commercial arbitration mediation with Italy, and I say a lot of chartered accountants in Italy are arbitrators or mediators. So there's a huge potential, and you can see slowly, these things coming into the taxation area as well. But be that as it may, there's still a huge scope in terms of exploiting the dispute mechanism and trying to bring some sort of sanity as well as certainty to cross-border tax issues, which is what will be the focus for today's session. Now, what I'm going to do is I'm going to going to touch upon the need for an effective dispute mechanism very briefly, albeit, and then get into the tax treaty dispute resolution mechanism, because I thought it is important to set the tone. And at a situation where we are in a huge phenomenon of globalization, and COVID has exacerbated digitalization, the fourth industrial revolution, quite a lot of aspects. So I thought I'll quickly set the tone and then move on to what I desire to probably touch upon, which is the tax treaty dispute resolution. Now, we know one thing that has been lingering among the minds of all stakeholders concerns, especially largely taxpayers, including governments, is the need for tax certainty. Incidentally, in 2016, there was a survey conducted upon some 800 multinational enterprises, and India was ranked #1 in tax uncertainty. So not something which we should be happy about, but unfortunately, that's the sorry state of affairs we are in. When many of these, being an importing country, many of these developed economies, or any economy as a matter of fact, all the more for a democratic economy, you need is a rule of law. And one of the fundamentals rule of law is having certainty and simplicity. Unfortunately, when it comes to taxes, we neither have certainty nor it is simplicity. I still remember, one of the US senators said, tax complexity is a tax in itself. So today there's huge amount of complexity. How do we apply the crossing up, attribution of profits, PE, transfer pricing, and pillar 1, pillar 2, a very complicated digital economy proposals. So it is, unfortunately, quite a lot of uncertainty surrounding us, and therefore there is a absolute imperative need to have some sort of a certainty. Now, how do you determine tax certainty? Because I've always wondered, people keep talking tax certainty. Okay, all right. So how do you measure it? Because as Peter Drucker, the management guru, said, you cannot measure what you cannot, you cannot manage. Unless you measure, you cannot manage. So you need to measure. You need to define what the tax certainty is, because these are all very subjective, inexorably subjective terms. Certainty, neutrality, fairness, pay fair share of taxes. So therefore, it's imperative that we understand what certainty is. Of course, IBFD has tried to define what a tax certainty is, which I'll not go through it before your screen. But then from a cross-border investment framework, if you have to delineate and define what a tax certainty is, It is basically the capacity to determine the tax cost associated with an investment. So from an investment standpoint, an investor, for him, tax is an obligation, and he would like to know what is the tax cost. He doesn't see it, tax as how a resident, he will see it as a cost. So it's important he determine the tax cost, and you cannot leave it this particular part uncertain. No, we may have to go on a bill. How much? What is the probability of we winning? Even as professionals, unless we give a very clear picture, this may be challenged. Not sure about the outcome. There are judicial in the creativity as well. It doesn't augur well even from a professional standpoint. So therefore, there have been efforts to make these tax certainty. The Supreme Court in the Vodafone judgment also clearly laid out the need for tax certainty. But that apart, tax certainty is important for government, business, and tax administration. For government, that determines the investment. You have, India is a non-adversarial regime. You have a lot of tax certainty clear. Why do people look at Singapore? Why do people look at some countries like Netherlands, which do not have substance, or rather which are not market economies? Largely because there's some sort of a certainty in it. So now, a certainty coupled with substance is always possible as long as there's certainty. So government needs those certainty in order to attract investments. Businesses need it. Again, businesses need the certainty in order to determine their profitability, how much should they bear as a tax cost. From a tax administration, it is all the more important because almost statistics say 80% of major corporate tax revenue are collected from specific 1,000 MNEs who contribute a larger chunk. So it is these MNEs, which multinational enterprise, which contribute a larger chunk. So it is important, even for tax administration to collect revenue, there has to be an element of tax certainty. Having mentioned about tax certainty, what are the causes for tax uncertainty which we are currently going through? There are various factors for tax uncertainty. One is the tax policy design, administration, especially for developing countries. Tax administration is tax policy. So unless you administer, you're not going to end up getting a sound policy. And there are specific international tax issues like transfer pricing. One of the major factors is dispute resolution. Now, dispute resolution is seen as one of the major issues for tax uncertainty. And from an India standpoint, it completely stifles the India's economy's growth because India is a highly litigant country. And if you look, the economic survey published a couple of years back, 85% of the appeals were filed by the government, and majority were tax matters. Now, what is the impact? Legal cost to the government, litigation cost to the taxpayer, because I always believe business of business is business, and business of business is not litigation. And even though it may not sound well, between litigation professionals may not like this, but the fact of the matter is, that's why I always prefer non-adversarial dispute resolution mechanism like mediation, largely because the business should focus on business, and that's how we should go, and not keep fostering litigations. And this also has an impact in terms of reduction in investments. Quite a lot of public infrastructure projects, money is being locked up, not being utilized for the desired objective. There's a negative public perception already. India is being seen as a very adversarial regime. Ease of doing business gets into. So quite a lot of aspects. It does stifle. It has a ripple effect in the economy's growth. Now, interestingly, just to put whatever I mentioned to ensure that it's not very abstract or very theoretical, I had an opportunity to work with the Institute Research Committee, trying to understand at the ground level. So I had an opportunity to survey 50 top international tax professionals, accountants, as well as lawyers. And invariably, many of them mentioned dispute prevention resolution is a key ingredient for tax certainty. Now, I'll come back to some other intriguing facts from the survey which we undertake. You can find the report in the ICAI website as well, even though the report was focusing only on domestic dispute mechanism. But then it gives some empirical study through a survey as to who the professionals who are at the ground level implementing these, what are their takes in terms of what's happening in the dispute mechanism for cross-border tax matters. Now, major reasons for cross-border tax disputes. One is tax treaty. For example, Karthik in this discussion about MFN, OECD member, sometimes tax treaty interpretation could be an issue. As the other factor is, these are the three major reasons I see for cross-border tax disputes. One is in tax treaty, which we'll get into it. Domestic law and tax treaty interplay creates a friction and thereby have cross-border tax disputes. And obviously, transfer pricing being a major role, and you always have disputes coming in transfer pricing. Now, when it comes to tax treaty, what are the common tax disputes that we encounter? Double taxation, or at times, many times, non-taxation, which is becoming an issue. The reason for PEPs coming in, the MLI, which Karthik emphasized in the previous session. And then you also have interpretation, because tax treaty interpretation is one of the most, I've always wondered, in India, especially I found, obviously, you cannot have a clear principle for tax treaty interpretation, even though you would want a common interpretation, because tax treaties are entered by diplomats and they're not legal, unlike your statutory interpretation, which are absolute literal sense. When it comes to tax treaty interpretation, these are general English words, and you give a liberal interpretation. So therefore, it sometimes many times professionals read tax treaties as if they're reading tax laws, and courts also add their fair bit of flavor, creating a whole lot of issues. And today, if you see, we have each tribunal, high courts, even Supreme Courts, as a matter of fact, come with their own way of interpreting, and need to understand the fact that the tax treaty or international law, public international law, has the Vienna Convention has a different style which needs to be followed, and you cannot follow the same set of interpretation what you do for a statutory interpretation. Unfortunately, this leads to quite a lot of interpretation issues. And India's absolutely classic example, considering the amount of litigations that our tribunals and high courts keeps churning out on international tax matters. We are a factory for tax treaty interpretation issues, complexities, etc. A characterization of an income is one of the larger issues. Should it be a royalty software? Should it be a business profit? Should it be fees for technical services? Should it be other income? And then similarly, other aspect is treaty entitlement. The cars control. The specific anti-avoidance rules. Countries invoking them, bringing them. Similarly, whether a single member LLC, which has a pass-through status, hybrid entities, are they entitled to access a treaty? Are they persons at the first instance? So you have, quite a lot of those kind of issues creeping up. Dual residency, nationality, habitual abode in one place. So these are some aspects which you see. Another aspect is the PE, which something which we have discussed a lot. Attribution, existence of PE is a big issue, and then the next part is how are you going to attribute it? We have now come out with a draft formulary apportionment kind of attribution, but then attribution has always been at the whims of the tax authorities. So that creeps of cross-border tax issues. Withholding taxes, we've seen in the previous session, Karthik dwelled a lot on the complexities and application of withholding tax provisions. Cross-border employment is something which I believe you will see more often. They're going, especially during COVID, already quite a lot of standard employees are being in India, 182 days. Companies deputing its resources to its group entities across, who has where is the employed, economic employment, and all those things, legal employers. So you have those kind of issues coming up as well. And then discriminations, where non-residents are not given adequate deductions. This is something we have seen in India as well. So these are some of the common tax treaty disputes that we encounter. Now, when it comes to the second pie, the other pie, which is the domestic law and tax treaty interplay, obviously there are quite a lot of inconsistencies because of unilateral override. Equalization levy is a classic example, and many times implementation of tax treaties is becoming an issue, because some countries, for example, you take Brazil or Switzerland, you cannot just like that keep coming out with a treaty amendment or protocol, because it has to be approved. There has to be a referendum, and in Brazil, passing an international treaty is not that easy. The constitutionally has its own challenges. Even you take in India, Netherlands came out with a clarification on MFN in 2011. It's very surprising to see India after 10 years now, post the dividend regime changing, now reacting to it. We could have all the more, in 2012-13, we could have always gone on board with Netherlands, use MAP, try to clarify it, whether Slovenia will get it or not. Could have solved all the issues that we are now going through. These are small basic aspects which could have been, because when Netherlands had come out with such a proactive measure in 2011, why not India could have initiated? If India was not happy with Netherlands' way of dealing it, they could have always called. You have the provision, which we are going to discuss under Article 25, 26 and the MAP. The countries can come together and interpret treaty terms. So they could have all the more done that. It's a pity that they didn't do it, which is now leading to needless disputes before the Indian courts. Similarly, as I already mentioned, hybrid instruments treating debt, equity, domestic law one way, international, the treaty may look at it other way. So and then mismatch of entities. So these are some of the interplay between domestic laws and the tax treaty. Now, transfer pricing, of course, many of us here would be aware of the issues that we encounter largely because of incomparables, and transfer pricing by itself is, neither an art nor a science. It's always, we come with one aspect and then the department will come with various aspects. There are marketing intangibles, those kind of, issues that crop up legally. Sometimes professionals also, in my view, have exacerbated many of the transfer pricing disputes with due respects. Because if we believe chartered accountants are well equipped to handle a transfer pricing supply chain because of our, possible exposure to business like internal audits, control system, the financial control framework. We understand better framework. So, and therefore we are in a much better position to set up good supply chain practice. But despite that, there have been instances where, I believe professionals have also contributed to the complexity or disputes in transfer pricing. And again, cross-border transfer pricing disputes bilaterally, largely because, for example, Brazil does not follow Brazil has a unique transfer pricing methodology. So you have those kind of issues, leading up to transfer pricing. So broadly, these are the three, major issues that you come across in a cross-border taxation scenario in international tax. Now, coming back to the survey, which I undertook along with the ICAI, a majority of the tax professionals felt transfer pricing, PE, and treaty entitlement as a major source of tax disputes, major source of cross-border tax disputes. Now, having set the framework for the disputes and the uncertainty that is around us, let's see how before we move on to the subject for the day, which is treaty dispute mechanism. Let's quickly look whether there are two ways these kind of international tax disputes can be solved. One through a domestic dispute mechanism and another through the tax treaty dispute mechanism. Now, when it comes to domestic dispute mechanisms, these are basically the tools that we have to resolve disputes, to prevent disputes. I have one more term which I've introduced in my report as well. It's called dispute containment. Dispute prevention is, prior, to have disputes. Dispute containment is containing disputes at a very early stage, be it at the assessment level. These are some aspects where we can, during the audit, tax audit time, during the audit scrutiny time. So that way you contain the disputes, nip it at the bud, as I say, as early as you're able to contain it, well and good. Because at least I have seen in the commercial side, today clients are willing to lose in year 1 than win in year 15. So therefore, all they need is some sort of a certainty. And obviously, if we're still going ahead, then there are dispute resolution mechanisms. So broadly, I'll classify into 3 buckets as prevention, containment, and resolution. So these are something which all of us are familiar. But what I want to quickly touch upon is, we figured out that, on the survey, surprisingly, if you look at the authority for advance ruling, which is one of classic dispute prevention mechanism, which was wonderful when it was initiated, unfortunately didn't live up due to various administration issues. So it has not been a good, effective prevention mechanism. Similarly, if you look, safe harbor has failed to be a effective dispute mechanism. One good thing that we figured out is this advanced pricing arrangements, which is slowly creeping up. Quite a lot of applications are coming. That has been, that is getting good response. And many of these survey participants said, yes, it is a very good, effective dispute prevention mechanism. Obviously, when it comes to tax assessments, 92% whopping said, no, the tax assessments when it comes to cross-border tax are ineffective and it only acts as a breeding ground for tax disputes, which is indeed a very sorry state, because this is the dispute containment I'm talking about. But unfortunately, there seems to be no containment. It only keeps increasing the disputes, and hence, the courts and tribunals are clogged. Now, these are other aspects. You can always look at this. Now, all these effectively show that yes, there is tax uncertainty and the domestic dispute mechanism, but for advanced pricing arrangement, has been absolutely ineffective. So which means we have been flooded with quite a lot of disputes, and many of these disputes are before the ITAT or at the various hierarchy till the Supreme Court. So with this one aspect from a domestic dispute. Now, what is it from the treaty dispute mechanism? Does the treaty envisage a situation where we have a dispute mechanism being prevailed? Yes, you have the mutual agreement procedure, which essentially is a dispute mechanism spelled out in the tax treaty. So you could find out in the tax treaties. Now, what does it say? It says, look, this is separate and independent from the judicial and administrative dispute resolution mechanism provided under the domestic laws. So this is separate, this is independent to the domestic laws remedies, and these are outside the domestic laws. For example, when you're not taxed in accordance with the tax treaty, then you can go in for a mutual agreement procedure. Now, mutual agreement plays a very crucial role in promoting the fulfillment of treaty obligations. It provides the foreign taxpayers, basically, foreign taxpayers who access tax treaties, that look, I'm giving you assurance. If there is a incorrect application of tax treaty provisions by one treaty state, you please bring it to the attention of tax officials from the other treaty state. Now, therefore, MAP is a very, very critical component of tax treaty and very important for foreign investors and other taxpayers. This is also important because many times foreign investors don't have their faith on administrative tribunals and courts of the investing country or the host countries. They may feel they are impartial, they're partial, they lack the expertise, they don't have the necessary resources to handle complex tax treaty issues. So therefore, there's always an element of skepticism. Hence, the need for a MAP kind of a situation is very important. And that's how MAP started to creep into tax treaties, the early, probably mid 20th century, once you started to have the League of Nations preparing the different kind of model conventions. Now, all modern tax treaties has an MAP article, which we are going to see in detail. It is very applicant specific. So there is no binding precedent here. And it is not available in public as well. So you have no idea as to, unlike your advanced ruling, which is available for you to have a persuasive value, even though it didn't have a binding precedent, you do not have such kind of a option. So therefore, it is very applicant specific. So hence gives some sort of a comfort to the taxpayer also, because of sensitive information that may be there in the. But this is again a very, very, very important aspect, which again I will touch upon when I talk about the advantages of MAP. Now, the very interesting or main feature about the MAP is it is a state-to-state dispute mechanism. This is very important. So this is handled between state to state. Unlike your bilateral investment arbitration, you would have seen the Jain energy case or the Vodafone case. It is investor state. So first time you have an investor suing a state. Even in WTO, you don't have that option. It is a state-to-state dispute. So many of these public international law treaties envisage a state-to-state mechanism, but for bilateral investment arbitration, which is very unique, which allows investors to directly sue the state for unfair treatment or for various other factors under the bilateral investment agreements. Now, coming back to tax treaties, so it is between state to state, so which means competent authorities. The competent authorities are the tax officials who will consult each other and endeavor. So the word used here is endeavor. I'll come to it subsequently. So they endeavor to resolve differences or difficulties on the interpretation or application of the tax treaties. Now, these are the broad framework of a mutual agreement procedure. Now, I would put MAP. Ms. Gauri, if you can put yourself on mute, that'd be helpful. Thank you. Now, I would bifurcate the MAP process in obviously, we're all very familiar with sequels or version 2, 2.0, season 2, season 3, 2.0. So I will go with that trend. So I will fragment map into two, map 1.0 and map 2.0. We are in the map 2.0 stage, which is in the BEPS era, and all the more it gives us a lot of opportunities, and that is why this particular topic that we're discussing has huge relevance for taxpayers, for government, as well as for tax professionals in providing clarity and certainty. I'll come to map 2.0, but before that, just reflections of map 1.0. Now, since many of the tax treaties were, I'm sorry. Now, many of the tax treaties were entered in a pre-BEPS era. Of course, now MLI helps you to modify those treaties. That's the reason for MLI. But when can MAP be invoked? Let's look at the legal basis. Now, we've seen MAP is a state-to-state dispute, applicant-specific, to resolve disputes if it is not in accordance with the tax treaty. Now, MAP can be invoked in three situations. The first situation is it can be initiated by a taxpayer if he feels that the tax treatment meted out to him is not in accordance with the double tax convention. So if it is not in accordance with the tax convention, so the key factor here is the tax convention. So it is not in line with the tax convention, the taxpayer can initiate a MAP. Now, there are provisions for tax officials also to initiate MAP. When can they do? They can do if there are difficulties and doubts arising to interpretation or application of the convention. So if there is this is not specific to one taxpayer, it can be to the tax treaty as a whole. It can be applicable to anybody, whoever accesses the treaty. So if there is difficulty in interpretation, similarly, if elimination of double taxation is not provided in the convention, this normally comes when you have a permanent establishment in a third state. So let's say a company is a resident of one country A, and it has a PE in country C. And now, normally, if you say country C won't get access between country A and B. So in those kind of situations, country A and B can come together in trying to resolve the disputes. So this is what 25.3, Article 25.3 of the Model Convention. So when there are double taxation in case not provided in the convention, example would be largely the PE situated in a third state. In those kind of situations, the two countries can come together and try to arrive at a solution. So these are the three situations in which one can invoke MAP. Now, going into the details, we are largely concerned about initiated by taxpayer, which is 25.1 and 2 is our focus here. Now, if you look at the 25.1 of these are model conventions, the OECD and UN are almost similar, but for some minor changes. Now, 25.1 says a taxpayer, if he considers that his tax statement in one or both states is not in accordance with the treaty, then he can present the case to the competent authority of the state of residence. Or in cases where a discrimination based on nationality, he can approach the MAP. So now, essentially, if you do not tax in accordance with the convention, you can go apply to the competent authority in where you are the resident, where you are a resident. Similarly, if you are not a resident, but even if you are a national, in such scenario, you can go and apply to the nationality state as well. So this is 25.1, the taxpayer initiated. Now, 25.2 gives the obligation. It says the competent authority must come together, consult each other, and try to resolve the issues. So basically kind of a bilateral situation, or wherever the competent authority feels they themselves can resolve it, unilaterally they can resolve it as well. Now 25.3 and 4, which we have already seen, this is basically tax administration initiated. That is, if there is interpretation or application of treaty, there's a common issue. Similarly, if there is third state PE and how to eliminate double taxation in such a scenario, they will come together, use the MAP. So this is broadly the legal basis for the MAP aspect. Now, MAP will, as I mentioned to you, MAP is a state-to-state mechanism. So it will be driven by competent authorities, CA. So the CA, if I keep saying CA, it is not the chartered accountants I'm referring to in this context, it is the competent authorities. The competent authority, who are they? They are defined in the model convention, both in the UN as well as in the OECD model. From an India standpoint, you can look at Rule 44G, which defines who a competent authority is. He shall mean an officer authorized for discharging the function. So basically, the competent authority will take up your matter with the competent authority of the other jurisdiction and try to resolve the issue. As I mentioned to you, this is a state-to-state dispute settlement. So competent authority will represent on your behalf. Taxpayer will not get direct participation. So it will be through the competent authorities. Now, who are the competent authorities in India? You have the Foreign Tax and Tax Research 1 division, which handles North America and Europe related map. And similarly, the second team, 2, handles the rest of the world, Africa, Latin America, Asia, and Australia. So this is the competent authority. Now we need to, if we have an issue, we need to apply to these, depending upon where the region is, to apply to them, and then they will in turn take it up with the other bilateral competent authority. Now, some common issues for resolution under MAP. Now, if you look, some of the common issues are normally that what you come across is something which you've already seen, is the characterization of income, whether it is a royalty or whether it is a business profit. So invariably, you have such kind of a situation in terms of what is the legal, how do you characterize an income? And the next issue that comes about is, as I mentioned to you already, transfer pricing. In fact, the MAP framework says the large number of cases is on transfer pricing in terms of, for example, whether there can be a corresponding adjustment is being given, not given, Article 9 to say, to give you an example, company A, which is a resident of state A, is a subsidiary of B, which is in state B. Then in such a scenario, if any adjustment made in state A, a corresponding adjustment should also be made in company B, which is situated in state B. So these kind of corresponding adjustments and elimination of double taxation, these are basically economic double taxation, but then still double taxation. So they normally come into some sort of an uncertainty and especially transfer pricing adjustment. So MAP plays a very critical role in allowing for resolution of such disputes, so that the same profits is not subject to tax in two different hands, the economic double tax. Treaty entitlement, this has always been a subject matter of issue. For example, this is something which I've commonly come across in the recent past, single member LLC in US. Now, single member LLC is disregarded entity in US, which means it is a flow-through entity, and it gets directly taxed in the hands of the single member, who's like akin to a sole proprietor in India. Now, India is not giving treaty benefits because under India's view, single member LLC is not a form of an entity. It is disregarded. So therefore, India consistently denies treaty entitlement. So you get these kind of issues coming up for MAP. PE, we've already discussed quite a lot of. Similarly, dual residence as well as the non-discrimination part, which is, for example, a foreign company is not being given a deduction of certain payments. So therefore, one can invoke the non-discrimination. These are some of the common issues you come across. Now, what is the advantages of going to an MAP? As I mentioned, it prevents double taxation, which is the main objective. The reason for MAP is this. Provides inconsistency and clarity. And this is very, very important because the treaty terms, as I mentioned to you, are diplomats' language, and you need to have a common interpretation. It's not about one country interpreting in one way. The other country should also interpret in a uniform, same manner. That's what is called the common interpretation. So MAP helps in removing inconsistency and clarity. And if you see, domestic measures only resolve disputes partially. What I mean by that is, it only, unilaterally. In India, Supreme Court may give, but the other country may not accept that view. So therefore, it's only half complete. So MAP enables you to resolve in both the states. Now, personally, this is the biggest advantage I see, and that's why I believe the right time for professionals to advocate MAP is because the tax treaties are negotiated by the competent authorities. So they know on what basis certain negotiations have been done. Why has this been given taxing right to that country, that country? What was the objective when they wanted to enter as a royalty? What was the rationale? So therefore, the competent authorities, we may not have the negotiation notes with us at the public, but at least they may have an access to it. So they may have a far better idea as to what prompted them to negotiate. For example, I believe India has its own model convention, which it's not there in the public domain, but they give it to countries with whom they're going to enter fresh or to negotiate. So those kind of model, treaty policies, India's treaty standpoint is not, so they may know better since they are also representing the MAP. Any day they are better equipped to handle and convince the competent than a domestic court, which with due respects has very limited exposure to international tax law. And therefore you see a variety of courts giving their own views. Again, with due respects, I believe that the competent authorities are in a much better footing than the judges or the professionals in the domestic court. Very, very less expensive, and more importantly, protects taxpayers' privacy. Unlike you go to a high court or a Supreme Court, when the transfer pricing matters. In India, we don't have the concept of retroactive. Incidentally, there was a recent Madras High Court judgment which says right to be forgotten. Should an acquitted person's name be removed from the judgment, even though the court said it is not there, because our system is like that. We don't have a right to be forgotten yet rule or retraction. MAP gives an opportunity for taxpayers to share all the information to the tax authorities, and thereby certain confidential information which should not be there in public domain will not be there. So you get that advantage, protects the taxpayers' privacy, and as I mentioned to you, it allows the resolution. And biggest advantage MAP gives also is you can also apply for MAP on a probable taxation situation. What I mean by probable is where you foresee that there is going to be a taxation. Even for those probable situations, you can get, this is like an early tax certainty. You can try to go get clarity on these probable matters. For example, draft assessment orders. Even though India says no, we will take it for MAP, but we'll wait for the final assessment. But this is one such. Or for example, India comes out with a position saying this is how they will treat cryptocurrencies. This is how they're going to have, treat software payments. So, and as a taxpayer, as a non-resident, you believe this will have potential tax implications in India, then those can be probable situations for you to access MAP, and more importantly, try to get an early resolution in such an issue. That's another key advantage of MAP. Now, having talked about the advantages, quite a lot of shortcomings as well. Some of the shortcomings are, as I mentioned, there is no mandate for the competent authority to resolve a dispute. So therefore, the endeavor. So more likely than not, they don't come to a conclusion. I mean, there's no push. I'm not saying that, but there's no push for them. There's no deadline or timetable to resolve a dispute. In many situations, lack of training and capacity building for governments, especially competent authorities. India is well equipped, but you take any other African country, they lack, there's one tax official who handles both direct and indirect taxes. So they are short staffed, not enough budget. So you can't expect them to come early for negotiation, understanding complex international tax law principles. Similarly, other disadvantage of is taxpayer is not participating fully, even though he is involved in giving submission, giving documents. When it comes to negotiation, it is only between the competent authorities, and taxpayers are kept in the dark. So you are not involved essentially in the process. And then There is also lack of domestic law support. For example, non-implementation of MAP. There may be some conflict. In India, MAP is not allowed if there is an order from the income tax appellate tribunal. You cannot go for an MAP if there's an order from ITAC. So you have these kind of shortcomings that you have, and procedural ambiguities are there as well. You are not sure as to how to go about and all those cases, and that, as I mentioned, it takes quite a lot of time as well to get a resolution. So therefore, these aspects, these shortcomings, sometimes overweigh the advantages that we saw in the previous slide. Now, how has been India's experience on this? India has a large inventory of MAP cases, but unfortunately, in MAP 1.0, if you see, the MAP framework was not effective. Now, why it was not effective is because of huge number of inventory India has, and the amount of time taken to resolve those were very high. At times, it went to more than 100 months to solve an issue. 100 months, you can put it. So average, but average time, if you take 68.7 months, almost 5 years, 5.5 years. In attribution cases, it takes almost 3-4 years. This is average. And so because lack of adequate resources, large number of MAP issues, and sometimes in India, we also had at one point in time some sort of a ego conflict between competent authorities of US and India. So these kind of issues also pull back the efficiency. And many times there is lack of procedural guidance, how to go about, what is the form, what is the process. The taxpayers had no idea what was going on. And as I mentioned, very time consuming for non-TP cases. It was taking more than 100 months. TP cases again 4 or 5 years. So therefore, overall, and we didn't have data. Unfortunately, till 2016, there was no data as to how much MAP inventory we're having, what is the turnaround time, and as a tax professional, when you advise a client to go for MAP and then you're just waiting for your turn, you never know when resolution will happen. It cuts a sorry figure from a professional perspective as well, because you every time have to follow up with the department and then tell them no, anytime they may take. So all those kind of issues were there in the MAP 1.0. Now, having said that, the MAP inventory kept on increasing. So it is not that the large reason is again because of uncertainty, and people wanted to get certainty, and especially MAP in developed countries were very successful, be it joint audits, cooperation, especially in the European region. There was a lot of traction. So many of these multinational enterprises was hoping the same sort of efficiency can be seen in India as well. So the MAP inventory was going on, and then that's when you also had this base erosion profit shifting action plan coming up, and many of those BEPS initiatives are also had to be implemented in the domestic law. For example, your thin capitalization was one of the aspects, your CBCR reporting, and similarly, you have your hybrid mismatches. So therefore, all these BEPS initiatives, be the PPT, etc. Now, all these things will only exacerbate more disputes, which is what Karthik also echoed in his previous session on withholding tax, the amount of issues we are seeing. Beneficial ownership is one aspect. So you have a lot of these dicey, nebulous issues. So the BEPS only exacerbates further when you implement them. So more disputes are possible. But one best thing about the BEPS, in my view, is Action 14. So the BEPS, even though the OECD anticipated, already there's clogging amount of disputes, and BEPS is only going to exacerbate. So this action item is very, very important. Because at the end of the day, no point bringing in, and you should have a solid, effective dispute resolution mechanism, which they implemented through Action 14, which came out, which is a mandatory minimum standard action item. Those minimum standards are MAP should be implemented in good faith, and MAP cases should be resolved on time. Similarly, it says the administrative process should promote prevention and timely resolution of treaty-related disputes. And taxpayers should have access to MAP, because one of the other issues that MAP had was the competent authorities were rejecting or objecting to taxpayer going for MAP, saying no, this is not, we are not going to give access to MAP, this is anti-avoidance, etc., etc. So therefore, the Action 14 was very clear. You have these three minimum standards. It's a minimum standard item as well. So therefore, countries should implement in good faith and should resolve in on time. Timely justice is essential. Similarly, everybody should get access, cannot be discriminated or cannot be denied access to MAP. And prevention mechanisms were also inculcated. For example, Article 9.2 was made for corresponding adjustments. Rollback of APA, which is that in the domestic law, was all triggered largely thanks to Action 14. Now, it's not about minimum standards and giving gyan or making enforced. The OECD also went one step further through the Inclusive Framework Forum for Tax Administration, which India is a member along with 50 odd countries, where peer review was instilled for all the members of Forum for Tax Administration. Now, the best part about peer review is it's like any peer review that we chartered accountants also undertake for some audits. So therefore, these peer review will help as to how India has been progressing, how India has been going about in terms of how are they implementing? Are they implementing MAP, or are they saying, okay, we will implement, but then if nothing is happening, then all these changes are waste unless these changes are implemented, monitored effectively. So peer review gives an additional cushion, backup, trust to ensure that the BEPS Action 14 recommendations are duly implemented, followed, and practiced. Now, not much of implications from MLI. Only one aspect. If you recollect, I mentioned that under the India's tax treaties on MAP, the condition is you can apply to MEP where you are a resident. But the MLI gave an option saying that you can apply to any of the contracting states, not necessarily resident. You can also be a non-resident, you can also go and apply. Let's assume I'm a resident of India, and if there's an issue with a US related matter, I can even go approach the US competent authority. This flexibility MLI gave, but India did not agree to it. India reserved, saying, no, we do not agree with opening up. It has to be only where you are a resident, and a taxpayer can approach only the respective resident competent authority in order to apply for MAP. Otherwise, the rest of the things like there are some treaties which did not have Article 25.3 and 25.4. Those things have now been ironed out thanks to the multilateral agreement. So bottom line is the model convention remains the same, but so that it gives more accessibility to taxpayers to approach MAP and try to resolve disputes. Now, we already had peer review. The peer review stage 1 and stage 2. Stage 2 report was released early this month. You should definitely have a look at the peer review reports available in the public domain. The peer review report in 2019 was, to me, a watershed moment because, as I mentioned, the peer review showcased the weaknesses in India's MAP framework, where India has not implemented certain things. So therefore, it gave a kind of harsh reality to India. Okay, these are the aspects, and somebody's peer reviewing it, and they say, oh, you need to work on these things. So that really helped. And incidentally, many of the peers, if you look where Australia, USA, Japan, Germany, and all these peers, around 15 odd peers, they constituted 97% of our MAP inventory. So they knew better about India's MAP process. So they found out what all inefficiencies they are seeing in India's MAP framework. Now, these things really helped us in terms of strengthening our MAP framework, which I will take it when we look at the practical aspects. Now, how does a MAP process? What is the MAP process? The MAP process is pretty straightforward. First, as I mentioned to you, you need to give a MAP request to the resident of the competent authority state. That competent authority state, if he believes that your objection is justified on whatever you're objecting on the tax statement, and if he feels they themselves can resolve it unilaterally, they will resolve it. If not, they will consult with the bilateral competent authority. They'll come out with a position paper and then come to a MAP conclusion, which is the MAP settlement, the fourth stage. And the last stage is implementation of this MAP settlement in the domestic law. Because once they come to a settlement, you need to implement them. And the problem also is implementation was an issue. Many times the conclusion has happened from the competent authority stage, but implementation has to be done by the assessing officer. So there was a lot of time gap, and many as taxpayers continued parallel appeals as well. So you had those kind of frictions going on. So implementation took a lot of time as well. So hence, that is very important as well, implementation. So now this is broadly the process. Give a request, unilaterally try to resolve it. If not, they can always bilaterally take the other competent authority into comfort and then decide, come out with a position paper and discuss the outcome. Once the map conclusion is done, give it to the taxpayer. He can accept it. He also has the option to reject it as well. He can withdraw it. But let's assume he's accepting it, then implementation. So this is the broad 5-stage process of a MAP. Now, some of the practical issues that one would see is, so I will now go through the, cover the procedural aspects through some practical situations. Having seen the processes, straightforward, go apply to the competent authority, then they will, once we do, our role is only, playing a backward role, being in the background, keep giving information, give them clarification wherever sought, and then rest of the main action will be taken place between the competent authorities. Once they come to a conclusion, they will give us the map settlement order. Based on the map settlement order, they can either, the taxpayer can accept it or reject it. If he accepts it, the implementation will come into play. Now, can a taxpayer participate in a map process? As I mentioned to you, he can participate in providing information, documents, clarifications, but he cannot be part of a discussion between other competent authorities. Maybe they can stay outside the room where the negotiation is happening, worst case, but they will not be inside the room because this is a state-to-state dispute settlement mechanism. So this has been under a lot of criticism. Many scholars of view that taxpayers should also participate. There should be transparency. These are not settlements. But then the country says, look, at the end of the day, these are settlements, negotiations. So we don't want taxpayers to get involved in such processes. Now, the treaty provides for a MAP clause. But one of the issues that is normally as a professional or as a taxpayer that they encounter is what should be followed? Are there any guidance in terms of, okay, we know I can go for MAP, there is an issue. I'm not treated in accordance with the convention. What should I do now? What is the form? What are the processes? How will it go about? Who should allow to make a MAP request? To which competent authority? When should I make? Is there a time limit? Is there any format or application? Is there a form or is just a general white paper? I just write it and give. Is there a fee? We have fee for filing APA. Do we have similar such fee for going to an MAP? We also have fees for ITAD, CIT appeals. So do they have a fee for MAP? And can there be a multilateral MAP? Let's assume an M&E group. I have India, Switzerland, Sweden, Australia. So can all of the parties are involved, say a cost sharing arrangement or a common managed services. So can there be a multilateral map? And what is the time frame? When will I get these map resolved? Will I get a resolution? If so, when will I get? So these are questions when normally any taxpayer will have, any tax professional will have. Unfortunately, if you look, for many of these, there were no answer in the map 1.0 era. Thanks to the peer review, and the peer review highlighting these inefficiencies, deficiencies in the system, the income tax department came out with 2 significant reforms. One is the amended rule 44G, which is now currently the rule for MAP processes rules, and also came out with a detailed guidance note on the procedural aspects from a MAP perspective. So if one looks at the MAP guidance, which basically has these details, what are the basic information, when will the map access can be availed, when can be denied, some technical issues, what is the implementation of map outcomes. The map guidance gives these clarity, and these clarity would not have emerged but for Action 14 and but for the peer review highlighting these aspects. So now, thanks to map guidance and the rule, the amended 44G, very clear rule, Today, we are in a much better position in MAP 2.0 than we were in MAP 1.0. Because the MAP 2.0, the guidance clearly says which form to be applied, what are the contents in it, what is the procedure to be filed by the home country competent authority once he gets an order. Similarly, by a non-resident when he gets an assessment order, what should be the procedure that they follow if India gets a MAP request, and my multilateral MAP is allowed, and then how they will communicate. The communication will happen through a position paper. It will not be a mere conversation over phone and say, okay. So that'll be a proper position paper which can also be accessed by the taxpayer on request. And India was also committed to resolve MAP cases with an average time frame of 24 months. So many of these questions, there is no fee for filing a MAP application. There's no fee to it. So now all these questions which were lying large in a hanging low, now they were answered thanks to the MAP guidance part A. Now moving on, some other practical issues that we'll encounter after the first stage once the MAP is done is, can a competent authority deny access to MAP on the following grounds? What are the grounds? Can MAP application be made after 3 years? Article 25(1), if you recollect, gave a time limit for 3 years. The case should be presented within 3 years from the time the person is notified. So once when you come, let's assume you got a order, from the time you get an intimation notice, that is the time when you know that there may be a potential tax. So from that to 3 years. So basic time limit available is within 3 years, you need to apply for MAP. Now I forgot, or rather I didn't do it. Can I apply after 3 years? If so, will the CA deny? The India guidance says, yes, we will deny. You should do it within the 3 years framework. It is like a limitation. You cannot exceed it. So therefore, you need to be cognizant about as to the time limit, when the time limit begins and when the 3 years time limit expires. What about, can I go for a draft order? As I mentioned to you, even probable taxes can be accessed to MAP to get early negotiation, early tax certainty. Somehow India has been saying no, draft order cannot also be said to be probable because you may also get a different in the final. But then what India says is, we will take up the draft order for MAP, we will count it within the time limit, but then we will do a protective MAP. The resolution will come only once we get the resolution will be made only based on the final order. So there is some sort of ambiguity in terms of probable taxes. Now, another very interesting aspect is withholding tax order 201. Now, normally what happens when an Indian payer, in the previous session we saw 15C, ACB, etc. When an Indian deductor withholds, fails to withhold taxes, then he gets a 201 order. Now, based on this, can an MAPB proceed by a non-resident? The department says, the income MAP guidance says, no. Withholding tax 201 is only an order for the Indian deductor, and this is not a final order for the non-resident. Normally, what happens when there is a failure to withhold taxes, 201 will go to Indian taxpayer, and then show cause to file return to non-resident will go. Non-resident will file the return, assessment will happen. If there are refunds, refund will come. If there are adjustment. So can a non-resident based on a 201 order invoke MAP? The income tax department says, no, you cannot do it. You have to wait for the final order to be passed in the hands of non-assessment. This has not gone down well with some of the counterpart countries. They are saying, how does it matter? Withholding tax of 201 Indian deductors means there's a probable tax for the non-resident. So you should apply MAP. So this is a kind of a rift going on, but the guidance report says we will not in such scenarios entertain the MAP. We will only entertain until only once the final order to the non-resident is getting an assessment order. Can MAP be denied on account of anti-abuse provisions like CAR, SAR? Because we have always seen especially AAR, the recent part has been rejecting applications invoking tax avoidance. So similarly, will a competent authority reject citing GAR or SAR? No, MAP will still be taken. One of the BEPS Action 14 clearly says you cannot deny MAP on account of anti-abuse provision. Indian guidance note also clarifies this. We will allow access to MAP. Another interesting issue that comes about is when I've opted for Vivad Se Vishwas, can I still go in for MAP? The departments, the Indian Revenue says, no, you cannot do it because this is a settlement. So therefore, we will not allow it. We will see some sort of a issue going on in this because Indian authorities are not accepting it, but counterparties are saying, why not? You should still go to MAP and try to arrive at a principal issue. So this is still an open issue. What about matters arising out of domestic law? Can CA deny access? Now, they can deny if it is a purely domestic law issue. But then, however, before denying, they should also intimate the other competent authority, get their views, and then they can deny. Because the MAP is applicable only for taxation not in accordance with the treaty. So therefore, to be on the safer side, it's better to consult your other competent, tell them the reason for rejecting. Say it is a purely domestic law issue, it has nothing to do with tax treaty, say equalization levy, and then close the, and then deny the MAP. Order arising from ITAT, Settlement Commission area, the Indian authority is saying they're all not accepting you. Once an order from ITAT is passed, which is Minister of Law and Justice, the government has to give effect to it. MAP will not override ITAT. So which means they are saying we will not entertain MAP applications based on a ITAT, based on trying to overrule an ITAT order. The ITAT order, we will respect it. Now, what about taxpayer undertaking voluntary primary adjustment and the transfer pricing? That cannot be a reason to deny because even though he has done voluntarily primary adjustment, maps will be still given and try to find out what is the appropriate amount of transfer pricing. So these are some of the nuances which I wanted to highlight. Once you start looking at it in detail, you will have these kind of practical issues emerging. Now, another important aspect is if a taxpayer who requests a map is also pursuing a domestic recourse through a court challenge, can it possible? That's the biggest advantage MAP has. You can do parallel both MAP as well as go for a domestic. But however, once the MAP order comes, you need to withdraw those appeal. But however, if it is an ITAT order, then if ITAT order comes first, then you cannot proceed. The competent authorities will not proceed further on the MAP application. So therefore, this is so parallel, or you can have remedy shopping available in both the places. Now, will taxes be suspended during the pendency of MAP? This is a very key issue. Yes, taxes will be suspended, but this is not coming out from the tax treaties, but this is coming out from some of the agreements entered between US, UK, and Denmark. India specifically has gone into a competent authority agreement under 25(3) and say, in such situations, taxes won't be collected until MAP is resolved. So you get an automatic stay. What about for countries other than US, UK, Denmark? You have to go to domestic law. Domestic law, if you go to ITAT, ITAT can give you stay up to 365 days. But however, you have the Supreme Court PepsiCo. If it is not on account of the taxpayer, then the 365 days limitation is not a bar. So you need to watch out what is the stay on the tax collections. Can a MAP application be withdrawn? Yes, it can be withdrawn, but with appropriate reasons. The taxpayer needs to indicate why he is withdrawing it. So he cannot then again come back later. So there has to be a cogent reason for a withdrawing. With regards to interest and penalties arising out of MAP, please understand MAP only determines principles, determines issues on principles, not on computation. So once the principal issue is determined, the computation is handled by the assessing officer. So interest penalty to that effect relating to the MAP will be taken care by the assessing officer. But there are some other penalty aspects which are beyond the MAP issue that will still continue under the domestic law. So one need to be cognizant about it. And MAP can be utilized for using your bilateral or multilateral advanced pricing arrangement. In India, we have very exhaustive APA rules. APA acts as a dispute prevention mechanism. So under the bilateral APAs, which is basically to avoid economic double taxation. We have already stressed on that. So if Article 9(2) is present in almost all the tax treaties, there are few tax treaties which does not have Article 9(2), that is giving corresponding adjustment in transfer pricing cases, but that is also plugged by virtue of the MLI. So therefore, MAP helps in resolving, getting clarity in the advanced pricing arrangement on transfer pricing matters as well. Now, how to implement? Okay, done, got solution, gone through the issues, I've got a solution. How to implement it? Can competent authorities conclude that they cannot reach agreement? Yes, because the Article 25 or 26 tax treaty only says they endeavor to resolve. They don't need to resolve. So they can always say we are not in a position to arrive at an agreement. But in practice, this is seldom, very rarely we have seen in India. But it could also be for other reasons. Taxpayer not cooperating could also be a possible reason. Now, can a taxpayer reject a proposed settlement agreement by the competent authorities? Yes, he can do it, and he can continue his domestic law remedy through whatever court he is parallelly pursuing. He can do it if he feels the MAP agreement is not in his favor. Now, should a taxpayer withdraw domestic legal appeals while accepting a MAP? Yes. If he accepts MAP, then he needs to withdraw the domestic legal remedy appeals in order to implement the MAP solution. Now, is there any time limit for assessing officer to implement? This is basically to ensure that the MAP is efficient. The rule 44G specifically mentions that once the taxpayer withdraws appeal nothing, within 1 month, the assessing officer must implement, give effect to the MAP agreement. Now, way forward, one must say thanks to the BEPS 14 and as well as the peer review, the time limits have drastically reduced. Incidentally, India also won an MAP joint award with Japan. So the OECD is promoting MAP or ensuring by giving awards, incentivizing tax administration for resolving disputes quickly. These are all part of the tax certainty program. And you can also see from the table before you that the average time is also reducing quite quickly. The turnaround time has reduced a lot, which really shows that we are in the right direction. And more importantly, taxpayers are also now happily approaching the MAP for a very simple fact that it may give some sort of a consistency, as I mentioned, the advantages, and more importantly, may get a fair, the other country also. So as an overall look from an M&E group, you cover all the bases, not only in a unilateral level. So things are heading in a very, very good direction when it comes to resolving international tax disputes from a MAP standpoint. Just some random quick thoughts on how to make this better. You also, if you're unable to resolve MAP within the timeline, both the OECD and UN model talks about arbitration, which is mandatory binding arbitration. So if MAP is not working, you're not able to come out with a solution within the time limit, then you go for a mandatory arbitration. But of course, mandatory arbitration is not preferred by developing countries, largely because they believe it's a sovereignty, lack of expertise of the arbitrators. There's no neutrality, and many times arbitrators will come from developed country. It may be a costly affair, and enforcing the arbitration award will also be an issue from a domestic legal perspective, also from a constitutional perspective. Now, UN model also advocates arbitration as part of alternative P in Article 25. But under the UN model, only a competent authority can initiate an arbitration. But in OECD model convention, a taxpayer can initiate. So these are small nuances. From an India standpoint, at this point in time, India is not an advocate of arbitration, largely because they've had bitter experiences in our bilateral investment arbitration. So India always believed tax is a sovereign matter, should not go to arbitration. But I somehow believe that's a very, very lame excuse. Bilateral investment arbitration and commercial arbitration has nothing to do with the tax arbitration. But anyways, for these lame reasons, India is not advocating arbitration, citing sovereignty as a factor, which in my view, again, I believe is not a very solid argument to deter arbitration. But nevertheless, you can also consider non-binding mediation. Some countries are contemplating non-binding mediations. They have in their domestic law as well, like tax ombudsman schemes. London, UK has its mediation scheme, have an expert coming in or within the tax. Even though a dispute resolution panel in India is also like a mediation, but unfortunately, it happens in a very biased manner. So non-binding dispute mechanisms can be looked into. World Tax Court is something which there are a lot of talks going on. Why not have a tax court in UN, similar to what you have a WTO dispute settlement body? Why not have a tax court which will hear all international tax matters? So that way you will have consistency. The advantage courts have vis-a-vis to an arbitration or MAPS consistency, because they are in the public domain, or probably courts will, binding precedents, fair justice, and all those principles will be followed. So that way, the advantage you have in a court system or a world tax court is that you get some sort of a stability and consistency. So with this, I due to lack of time, I know even the previous session took my time as well, but then I will stop here. The idea was basically to give you a framework on MAP 2.0, and this is a perfect time as well. And as chartered accountants, I believe we can play a very, very significant role in resolving tax disputes, because you don't need to be a lawyer, get into the bar to do a litigation practice. Here it's all about coordinating with the competent authorities, preparing the respective submissions, which we normally do in our faceless era, which we're going to do, and then try to resolve those disputes and give certainty. I believe MAP can be now is more inclusive, can be accessed by all taxpayers to get some tax certainty. So, of course, these are some of the general aspects. You can look at it, you find them. So with this, I'd be happy to take up any questions if there are.
Thank you so much, Sudarshan, for the wonderful session. And definitely, dispute resolution mechanism is one of the aspects wherein we as a consultant can play a major role. As of now, sir, there are not many questions, but as I said, we have a WhatsApp group wherein we are adding you as well. So I request participants, if they have any query, they can unmute and raise the question, please.
All right. I'm happy to take up any questions over WhatsApp as well. The idea, again, the objective is to largely give an overview picture about how we can make use of the tax treaty dispute resolution mechanism, right, and then try to get an early certainty and value add to our clients.
Thank you so much. On behalf of Nagpur branch of WIRC of ICAI, I would like to express my gratitude towards both the speakers for today's session, CA Karthik Mehta ji from Mumbai, as well as CA K Sudarshan sir from Chennai. It was a wonderful session, and the process of learning will continue tomorrow as well. Tomorrow is our last day of this national conference. So I request all the participants to kindly join tomorrow morning at 8 AM. And thank you all the participants for having patient listening. Thank you one and all. Thank you so much. We are signing off. Thank you, Karthik. Thank you, Sudarshan sir.
Thank you. See you.